Companies here, the likes of Unilever and Nestle, they were able to put up prices a lot. Now that we're in a different era where it's going to be about volumes a little more.
It is, and to your point about the margin story, I mean, if we're talking about them kind of having price cuts during that time, at what point do we then see this showing up in terms of not just pricing, but then the buybacks, the dividend story? Do you keep them up as the margins potentially drop? That means the European markets are officially open. We are, of course, going to be keeping an eye on a lot of these corporate stories, but right off the bat, the FTSE 100, well, Anna said it earlier, futures were virtually unchanged. It looks like at the open, virtually unchanged as well, but kind of tilting to the downside as we kind of go through some of these individual stock stories.
Absolutely. In terms of where the points are coming through, let's just kind of give you an idea of what's happening. ASML is up. We're going to get ASMI numbers a little bit later on. Watch for that. Novo Nordisk is rising today. The miners are popping back as well. SAP is up. So tech is back. So the granolas are looking like they're having a better day today. Good day for the granolas. ASML, Novo Nordisk, SAP rising as well. LVMH is up too. Ferrari's up as well. So the miners and the granolas are back.
Say granolas one more time.
Good day for the granolas. Sounds like a song lyric, I think.
Yeah. Anna's going to sing now.
No, nobody needs that with their breakfast. This is the sector breakdown. What have we got? Banks on the back foot, along with food and beverage, autos, personal consumer. In terms of the best performing, though, we've actually got the mining sector not doing too badly. That's up by 1% or so out of the gate. So that's adding a little bit of upside to London, actually. So despite earlier forecasts that we'd be flat to negative, we've gained a little bit. But basic resources, yeah. It's interesting. We saw a turnaround in the iron ore price during the Asia session. It was down earlier on, then turned upwards. There did seem to be some creeping optimism around, the seasonality of the steel market, and maybe we see something more positive there. And the fact we've seen iron ore prices dropping 12% in prices the middle of February meant that some people were talking about, steel companies coming back into the market to buy it up. But maybe that's something at the margin, just adding some interest to miners.
I want to come back to Smuckers. And talk peanut butter.
Back to breakfast.
Yeah, back to breakfast. Do you have peanut butter for breakfast? Not. Maybe.
Oh, yes.
There's definitely a lot of people that do. Unilever's down today. You got Ahold down today. So some of the big food companies are definitely down. As Anna would say, the fast-moving consumer goods companies, though I feel quite old saying that. Tesco down a little bit. So that's where we're seeing some of the weakness coming through. Some of the retailers are actually looking a little bit better, which is interesting in the light of the BRC numbers. But the BRC numbers today were telling us a story of food inflation that is coming down, which comes back to this idea of margins and the struggle that these businesses maybe are going to see.
What is your Smuckers experience? I feel like you need to maybe...
More of it.
Yes. I'm curious.
It is limited. Peanut butter's never been high on my list.
No.
Let's put
and other brands are available.
I'm not even going to fight that one because I'm not a fan myself. I don't know. The food inflation story is so interesting. We're talking about the natural gas kind of read through earlier as well. This is something that we haven't, I feel like, from an inflationary standpoint, paid that much attention to for, I want to say, 2 years when you started to see that increase.
But do you remember when gas prices went up and gas prices going up, we all thought about our heating, and then we realised that actually this is a feedstock for pretty much everything. The chemicals industry, the fertilizer industry, and that's why food prices went up, because input costs were so high.
Yes, I remember one of those, a day around that period doing a conversation with Yara, big fertilizer company out of Norway, doesn't feature in the sort of international global market conversation very often, but certainly in the early days of the war, that was certainly part of it.
But yet we're still waiting for it to kind of filter through to the consumer. People have still kind of been able to deal with the price hikes. Affordability isn't as much of an issue in the United States as it might be here, for example, in the UK or in Europe, and arguably even like if we're talking about Asia, Japan, for example. This is the key core issue, that wage growth isn't catching up with inflation. That's your tour around the world in food. If you did, I just want to point out one mover on the upside this morning. Aberdeen actually coming out higher by 5.4%. We talked a little bit about this. The numbers weren't that strong. They kept their dividend in place. That's the one I pay attention to. But they did miss on some of their numbers, yet the stock still one of your biggest movers.
Yeah, you wonder if a lot of the bad news was in the price. We already knew a lot about the difficulties they were having in terms of outflows. So there was a lot expected there, I suppose. So maybe that's it. And we'd already heard about the sort of self-help measures that they were taking with reducing their headcount as well. That was a story earlier on this year.
Yeah, it's really interesting because we're talking about these kind of doomsday dynamics, about inflation, about if you're starting to see fund flows kind of come out of some of these companies. How do you trade all this at a time when you're talking about very high valuations, when you're talking about European corporates in particular trying to hold on to a lot of their investors, and again, buybacks, dividends, I'll say it about 17 more times. It's really important, but then how do you trade it? We asked Maria Vateman of State Street exactly what that trade is. Take a listen to what she had to say.
Okay, but really under the surface we're seeing a lot more cracks, and so I think internal mechanics of equity markets is really worrying. But really the story for equity markets is, I mean, we keep repeating ourselves, is cash and tech. So tech is doing fantastically well, everything else is not great, so you go to cash. So that's really the trade for us.
All right, cash and tech, that is the trade from Maria Vateman over at State Street Global Advisors. Let's bring in another voice here and see if she agrees. Stephanie Niven joins us right here on set, portfolio manager over at 91. We thank you so much for joining us this morning. Is that the appropriate trade to you? What do you make of it?
Well, firstly, I'm sad not to be asked about peanut butter.
We'll get there. We'll circle back.
Are you a fan?
Definitely.
Okay, that's fine. We've got one.
But I think the tech trade is obviously very interesting. It's, been surprising how we started 2024 in the same way we saw 2023 with that dominant drive in the US in the mega tech names. But I don't think that's the whole story, and it won't be into 2024. We need to look beyond that sort of quarter of the market that's in that tech space and think more broadly about areas where there is valuation support, where there are those really compelling structural growth opportunities. And I think it's time for fundamental investors to really think, well, actually, where is the AI story headed, and where is the rest of the market headed, and where can I find those attractive valuations?
Well, let's focus on that rest of the market story. We had Gina Martin-Adams, our chief equity strategist here at Bloomberg Intelligence, speaking to us yesterday on the program, saying that the breadth story is irrelevant this time around. The fact that you have this concentration risk doesn't actually matter. If we're looking at the pockets of this rest of the market, it hasn't been performing that well. You'll see on an earnings basis, on kind of a share performance basis as well. How do you kind of pick through that? What's good and what's noticeably bad?
Sure. Well, I think it's important to point out that, we don't know where the AI story goes. So we don't know exact trajectory of where AI comes through. We don't know if we're in this kind of $800 billion US scenario or whether we're more like the 400 billion kind of lower end adoption rate. So there's no intrinsic clarity on where we go with AI. But with the rest of the market, you can see some really compelling stories where companies have that pricing power you mentioned earlier and have that ability to grow through challenging macroeconomic environments. We don't know where inflation is going to go. We don't know what the US consumer is going to do. But we can pick those companies that have control of their bottom line and have that ability to deliver those compelling cash flow returns that we want to see in challenging election years, which make it difficult to be an equity investor this year.
Stephanie, do you screen for geography at all? Is it a good time to be looking at geography here, or is that irrelevant given the sort of stock picking bets that you're talking about there? Again, with Gina Martin-Adams yesterday, the team were picking up on this conversation. They were asking about, is it Europe or is it the US? And she was saying, well, actually, she doesn't really favour either when you compare them to emerging markets. Right now, she had a preference there.
Sure. I think I would largely reflect that as well. So we think about the world from where are the structural growth opportunities? Where is that ability to look for decarbonisation opportunities, financial inclusion, healthcare, etc.? And you're right to pick up EMs because China is beginning to look a bit interesting, I think. So we're having that support of valuations and of policy in beginning to turn around the Chinese outlook. And I think, we're seeing that expansion of the PBOC balance sheet, which is beginning to look like there are some measures of real support coming through in the Chinese economy. And it's time for fundamental investors to look for those businesses that have that growth opportunity and have that ability to deliver sustainable returns with competitive advantages underpinning those. So I think it's right to look beyond just the US. The US is compelling in its own right, but those EMs are really at this point in the cycle beginning to stand out.
You mentioned healthcare, which takes me to something you mentioned in your notes, which is about looking at healthcare stocks that are away from the GLP-1s, those that which created quite a lot of frenzy last year, didn't it? The anti-obesity drugs. I know we had numbers out from Smith & Nephew. That's a sort of a different part, a medical equipment part of the healthcare sector. Where are you looking for returns in that space?
Yeah. So within healthcare, I think you see that parallel to what's happened in tech, where there's been so much excitement and so much, investor interest in those areas of innovation. And GLP-1s are, as you say, a really compelling area that tackles a chronic problem, particularly in developed markets, and thinking about weight loss. But that's not the only story here. And actually, the excitement around GLP-1s has created some interesting opportunities in the medtech space. So we're looking at names like Edwards Life Sciences that have that ability to grow through an aging population rather than just thinking about the obesity side of it. And you're right that in the UK, there's also some really exciting valuation support for the medtech names here. Thinking about Smith & Nephew, thinking about Convatec. Again, ways to really think about healthcare, but not necessarily in that super exciting area of innovation. This is more about improving a chronic underperforming system rather than that excitement that you've seen in the tech space that feeds into the healthcare space as well.
Equity markets have had a really good run. Do I put more money to work or do I take money off the table?
You have to look for the stocks. So
okay.
You're exactly right that headline valuations maybe look a bit challenging here. But if you treat it as a fundamental investor and you look for those businesses with sustainable drivers of structural growth, there is lots of support and there's lots of opportunity to put money to work in names across the whole space. And I think climate adaptation, for example, is another way of thinking about the climate change. We're having to deal with higher temperatures. We're having to deal with more challenging water access. There's names like Veralto, which spun out of Danaher last year, or that play into that theme. Or there's insurance companies and thinking about how people deal with the changes in climate that we've seen already and adapt to where we are today, and looking at the risk, the ability to protect against the risk in that space.
So when does the market broaden out into this kind of... The market's been really concentrated, back to this kind of concentration risk.
Record highs, right?
Right, so you've got the market pushing higher. It's a narrow group of stocks that are doing it on both sides of the Atlantic. Everybody's having this conversation about whether you broaden out at this point. You're giving me a whole load of names that are outside of that list. Does that imply that you think that the market is going to broaden out from here, that you are going to see uplift, the money coming out of that space going into these other areas?
Sure. I mean, last year, alongside the narrative in the Magnificent Seven, we also saw a lot of anti-ESG sentiment, a lot of concern around energy transition companies that really weighed on stock prices. And I think looking into 2024, we'll begin to see a resurgence of interest in those areas of the market where you have that valuation support, you have that ability to grow through, challenging election cycles, which generally leave investors feeling a little bit nervy. So it's going to be going back to basics, looking for businesses with pricing power and with that growth that leans into these long-term sustainability challenges that will deliver that compelling, larger total addressable markets over time.
Something that's so striking about this kind of AI tech-driven rally that you're seeing around the world is that nobody seems to be able to quantify it. We don't know how much investment's going in, when the payout is going to come, and how much that payout actually looks like. It's kind of this momentum trade that keeps snowballing. But I'm curious why we're not seeing something similar in defense stocks, for example, where the numbers are more quantifiable, where we can actually put numbers around increasing budgets that are then being allocated to defense. Why are defense stocks not seeing the same kind of mania around it that tech stocks are?
So I think what we've seen in tech with the development of generative AI has been so transformative that that's the exciting innovation that's really dominating the market at the moment. That's where you're going to get investors get really excited and drive those valuations through. And to be fair, we have seen a lot of earnings support come through. So the likes of Nvidia, they have been underpinned to some degree by that earnings expansion. And that's what, investors like to see. We like to see that visibility on the path to delivering returns and cash flow. I think defense is a bit different. You're kind of beginning to think much more about political concerns, a lot more about moral implications as well. So it's sticking on those real core areas where you have that visibility on the trajectory of growth and you have that underpinning that you are creating sustainable value for society as a whole.
And I suppose for that sector, watching what governments are saying about how reliable as a buyer they will be is important. We'll get back to that conversation a little bit later on this hour. Interesting one I wanted to just put to you, Stephanie, our colleagues writing a story about how debt-addicted companies are seeking equity as interest costs skyrocket. And this is talking about the relative cost of debt and equity, and saying that for the first time in over 2 decades, it's cheaper to sell shares than to issue debt. That's quite a big deal, really, isn't it?
Yes.
And I mean, what does that do? Because as somebody who's interested in stocks and buying stocks, clearly a lot of issuance might weigh on things for a period, but can also, deliver growth in the future. How do you look ahead to any kind of resurgence in issuance? We certainly haven't seen it recently.
Sure, and we have a number of investments that play into that theme over time. And I think the way to really think about it is that equity investors will be diving deep on the details of where companies are going to be spending that capital. So it's more thinking about, are these management teams in a position to allocate that capital that they raise in equity markets in a sensible way that generates that return that equity investors need? And I think we'll see a lot more scrutiny upon that from the equity investors going forward.
Stephanie, thanks very much. Thanks for joining us. Stephanie Niven, Portfolio Manager at 91. Let's get a check on some of the individual stocks on the move this morning. Joe Easton has a briefing for us from our equities team. Joe, what have you got?
So we're going to start over in France, where we've got a massive drop in Eurofin Scientific, down at 10% at the open. It may have even gone into a trading halt. The company is reporting a drop in cash flow. There it is, ticking lower again. The company reporting a drop in cash flow. It's lab testing equipment, a pretty stable part of the healthcare sector, but they are seeing weak cash flow. Unexpected, and that stock getting hit today. You mentioned Smith & Nephew just a few moments ago, up almost 5%. Again, it's a defensive part of the market. Medical tech doing pretty well, continuing to see strong sales. But SBB cannot catch a break at all. It's down 90% over 2 years. It's down another 7% today. A drop in rental income is the latest negative headline for them. But one stock coming up in the financial space is Aberdeen. You also touched upon that one. Outflows potentially stabilising at the Scottish company. So that one, it is down 20% over the past 1 year, but coming back up slightly today. Then we'll take a look at these sportswear stocks, because interestingly, not much of a read across the sector. Puma actually was up around 2% at the open in Germany, now up just half of 1%. The sales were pretty weak, but again, it's a stock that's declined a lot. And the other stocks, not seeing too much of a read across. Brought up Adidas, JD and Fraser's a Sports Direct owner, but all of those pretty much doing their own thing today. We'll keep an eye on Nike in the US later. Then in terms of a couple of deals to bring you over in France, we've got news that Peugeot is dumping around 250 million euros worth of stock in SEB, a French-listed household appliance company that they had a stake in for a number of years. That one is hitting that stock, SEB, down 5%. And JC is looking to sell some of its shares in a rival billboard maker over in Switzerland, APG. That one actually fell at the open, but it's coming back up. A bit of a boost for JC this morning. Then in terms of your morning calls, there's two, and they're both in the consumer staple space. A heavy one for Unilever, downgraded at Morgan Stanley, which says a re-rating in that stock is overdone due to the fact that emerging market sales are weakening. But more positive is one for L'Oreal. Berenberg likes this one, upgrading it to buy, saying it's got the best growth outlook in the entire consumer staple space in Europe. Not too much of a gain. Pretty much unchanged now, but Berenberg goes buy on L'Oreal.
Joe, thank you very much indeed. Back to the skincare story. Joe Easton joining us. Skincare matters, I was once told by a previous person I anchored with.
Skincare does matter.
Skincare matters.
It does.
As does peanut butter.
Not for skincare. Not together.
EQT is interesting this morning. 22 billion fund raised, clearly huge demand for that private equity fund. It's already partly invested, this fund, 22 billion. I think it comes back also, I think there's an interesting comparison to make with your point about equity and the fact that it's cheaper to raise equity right now than debt. It's better to raise equity rather than debt. It's interesting that what that tells us about valuations, the fact that EQT is looking, maybe it still sees opportunities. I'm fascinated by the fact that it is better to raise equity. You're getting a better price as a company to sell that equity, which maybe tells us also about valuations. One tells us that maybe valuations are low, others are telling us that it's high. I can't quite work out which one of those two it is.
Yes, I suppose if your universe is what are listed companies doing to raise money, then that tells you one story. But then if you stand back and say, well, there's listed companies and then there's all these other companies, what are they doing to raise money as well? There are a lot of companies that have left public markets, gone into the private space. It's a complex picture.
But EQT is looking to maybe do buyouts and And all I'm hearing at the moment is there are deals after deals after deals being lined up because equity valuations in the UK in particular look quite cheap.
Yeah, I'm going to give you a third option here in that valuations don't matter at all. I think equities as an asset class are really hot, and I think you're seeing that because it's not just the U.S. equity market that's hitting record highs. You're seeing it in Japan, you're seeing it in Europe, you're seeing it everywhere. So I think equities as a class are attractive, and therefore you want to get into it.
Goes back to NVIDIA last week, doesn't it? You know, if we really are talking about a step change, a significant development in productivity and a significant innovation that is as big as, quote unquote, the Industrial Revolution, some have said, you know, then that warrants something quite spectacular on the equities front, doesn't it?
But it's the only one that has. Can we just say that it's a unicorn? It's not and I mean it, and not in a financial term, but it is a unicorn. It's not indicative of the broader trend.
It's interesting that Alphabet's struggling right now. Yeah. Because maybe it's missed the boat on that, and the search story may be damaged by what happens with AI. Yeah, just momentum. Also, we've just got used to stocks going higher. Do stocks ever go down? Anyway, we're going to talk about fast fashion retailer Shein considering switching its IPO from New York to London. What does that tell us about London? We're going to talk fast fashion next, my favorite subject. This is Bloomberg.
Formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Could face bigger challenges next.
Was going to keep winning World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Markets Today, 22 minutes into our European trading day. Stocks are flat to positive, doing a little better perhaps than maybe we anticipated looking at futures earlier. The US futures picture looks pretty flat. Actually, we're waiting for some data points later out today from the Eurozone on inflation and later this week from the US on that same subject. Let us talk, though, about listings in London because Sophia Halter-Acosta joins us today from the Markets Today blog. And we have a fascinating story out from the team talking about the possibility of Shein, the big Chinese fast fashion business, could decide decide to not list in the US, as it had applied to do, but to consider listing in London instead. We'll see how long this story lasts. But this is the story of the morning, and it would be a big deal for London in terms of the size of it, but there'd be some controversy around it. What's your initial response to this story, then, Sophia?
It would be a huge win for the LSE. I mean, let's not forget that London would still not be the first choice for Shein. The US is still the first choice, and this is because it's facing regulatory pressure and questions in the US, as a lot of Chinese founded companies do. It's also facing regulatory issues in China from the CSRC. But for London, you know, the fact that it would be incredibly welcome here, I'm just looking at the valuation, it would probably be the 17th largest company in the UK by market cap, if we look at recently private evaluations. And this is a market that really needs IPOs. The US doesn't. You know, again, it's a fast fashion retailer. It has built a brand in the UK. Actually, it bought Misguided last year. It actually tried to buy Topshop, losing out to ASOS a few years ago. It had a pop-up store in Oxford Street, which I walked past every single day on my way to work. You know, it really has been trying to build up a brand here. And the founder did meet with city executives in December when he was here. So there's clearly some kind of relationship building in the UK. Whether it'll be a win for Shein, whether it'll be a win-win situation also for the LSE, remains to be seen. But again, it's second choice.
Does it then, if this does go through here in London, kind of open the floodgates for more international IPOs coming to London as opposed to shooting for that higher valuation or multiple in New York? Is Shein going to set the precedent for others?
I think that's a really good question. It also depends who you ask. I think if you ask the LSE or the UK government, they would say yes, they're trying to kind of create a more friendly environment for startups and for others to follow Shein. The question is whether Chinese companies and other companies, foreign companies, would find London as an attractive kind of first choice, because at the moment it's very, very clear that the US remains the first choice. That's a deeper pool of capital, far more liquidity, much higher valuations, especially if you're in tech. And ARM Holdings, you know, the kind of UK tech champion here, really kind of showing that that's where you get the higher valuations. Yeah. Fast fashion is not tech, so I think there's a little bit of differentiation there. But I think it's very hard for any listing venue to compete with the US still.
All right, Sophia Horta-Costa from our Marcus Today blog. We thank you so much for bringing us that crucial update. You get more from her and the team on the front page of the Bloomberg UK website. Just type in TLIV Go on your Bloomberg terminal. This is a crucial story for the IPO market, fashion aside, talking about whether or not this is something that London would want.
We're going to be talking to the LSE. So the LSE's got numbers later on this week. I'm fascinated to see what the take is on this. Why do you keep losing out to New York? Are we basically just picking up everything that doesn't happen in New York? Is that what's going to happen here? But is that what London wants to be known as?
You say that with such like disdain, and I wonder if that's a positive, though, that they're kind of picking up all this extra capital at a time when even American banks are looking elsewhere for that kind of return.
Yeah, we'll see what London says in general then about this, because regulators will be all over it. There's been concern in the United States about the supply chains, about lack of transparency around supply chains and around where they source their product from. So we'll see how that falls in London. London last year, $1 billion worth of IPOs, at the lowest in decades, a story we know well and have covered much on this programme. Coming up, we'll be back to the earnings stories. Earnings from Campari due later this morning, but will they be raising a glass to consumer demand? We'll talk about the luxury sector. We'll also talk about consumer sentiment. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, This is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I would put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're 30 minutes into the European trading day. It's a little bit of a nothing burger from an index level when you look at what's actually moving. The Stoxx 600 higher by 0.1%. A couple of corporate earnings there. Aberdeen continues to be one of the major movers this morning, but I'm gonna take a page out of Guy Johnson's playbook. It's all about the macro this week, and we're already seeing that. Even these earnings numbers aren't moving the benchmark that much, but I don't know that the macro numbers will necessarily either.
I don't know yet, is the honest answer, but big inflation numbers, like the PCE print, does it take us from 3 to 2 hikes out of the Fed? The market now seems capped at whatever the dots are telling us, but the dots can change, and maybe if the PCE numbers with all the other data, maybe we go from 3 hikes in the dots to two dots. Yeah. Maybe that's a pricing shift that we could see.
It's interesting, because going into the NVIDIA numbers, where everything pre-NVIDIA, seemed to be, the mindset, the grit markets seemed to be, these markets just want to go higher, and to the point you made earlier, any data point that came out that didn't fit with that narrative was sort of just put aside or explained in some way. I don't know, are we still in that mindset? We've sort of not done much ever since, and we're still recovering from Thursday. 2% rally on the S&P in one day is actually quite rare.
It's very rare, and you even a 1% rally on the S&P 500 these days is quite rare when it's this concentrated, I have to say. But I think what's crucial as well is, and Stephanie Niven was talking about this earlier on the program, about whether or not you can kind of quantify some of these numbers as well. NVIDIA seems to be the lone tech company that's actually able to say, here's what our numbers are going to get us for the next couple of years, and actually put numbers on it, whereas the likes of even Microsoft, Alphabet are saying, we're investing, we're throwing money at it, we don't really know when it's going to pay dividends.
But even NVIDIA's saying we only forecast quarter to quarter. This is an incredibly cyclical industry. Who knows what's going to be happening? And you asked the right question earlier on when we were talking about the idea that how much visibility do we really have? We don't know a year out, yet the stocks are pricing in kind of to the moon in terms of the kinds of numbers that we're seeing now and extrapolating them forward.
But when you see a stock move like this, and we've seen it with Tesla, for example, where you have this kind of massive, almost vertical momentum, nobody places bets on NVIDIA at the moment. No one gets in the way of the rally, even after the earnings story. The options market isn't betting against NVIDIA in a way that when Tesla showed a similar move, they did.
So what I think is interesting right now is there was a story out yesterday, hedgies are selling tech, but the options market is where they may be hedging that risk. We can sell the stock, take the profits, but buy the options, some of the out-of-the-money options on the upside,
Yeah.
and still potentially capture some of the gains that are still to come.
Yeah, really interesting to see which parts of the investment community are willing to take that leap of faith, if that's what it is, around the AI theme. Let's pick up on another earnings theme we've been dealing with recently. Earnings from drinks maker Campari are due a little bit later this morning. Analysts expect margin improvements this year, as well as strengthening consumer demand, specifically, or especially, in the second half. We asked key leaders from the sector about the state of the market.
We're still seeing strong pricing power. Our premium products are actually outperforming our mainstream products. So despite a weaker consumer, they may be buying a little bit fewer products, but they're buying higher quality and more expensive products.
It was an intense competitive environment, and we are focused on winning high quality market share. We're not just chasing, we're not going to erode profitability and brand equity by chasing, a couple basis points of share.
Some voices from the drink sector. Let's bring in Sweta Ramachandran, fund manager at Artemis. Sweta, very nice to have you with us. Talk to us about the consumer story around premiumization, luxury drinks. That seems to be the focus, has been the focus for some time in markets. But then we overlay that, the regulatory challenges that some in this sector now face, in particular out of China. We've discussed that with you in the past. Where do you see value in that space?
Yeah, I think this drinking less but better theme remains very much intact across the spirit space. Spirits as a category is still continuing to win share of throat from beer and wine, particularly in developed markets. Even though in emerging markets where affordability is lower, it's still beer in the ascendancy. But that trend across categories is very much about less but better, meaning the premiumization, as the Carlsberg CEO points out, is still very much there, except that consumers, pardon the pun, may be having a bit of a hangover following the pandemic boom when people were drinking cocktails at home over Zoom. That has led to a bit of a definite slowdown in growth. And as a result, the inventory situation in this industry and where the stocks sit is really the question of the moment, and how far through that inventory destocking we are.
Okay, so there are specifics attached to the drink sector to do with that hangover post all those, lockdown cocktail parties that I'm told people enjoyed.
Online.
Yes, absolutely. That's exactly what I was referencing. Let me ask about then what the broader consumer outlook looks like to you, Sweta. Are you concerned about where US consumers, for example, are getting their money from? What evidence do you see now the pool of savings is supposedly depleted, where the money is coming from, and does it give you cause for concern?
So actually, it's true that U.S. consumers, they've been the star of the show for the last year, incredible resilience in their spending, even after the post-pandemic splurge that they enjoyed. And I think there is some evidence that sort of HELOC, home equity line of credit, that is increasingly becoming a source of financing for many U.S. consumers. That said, credit card spending hasn't massively accelerated. And in fact, debt level growth is keeping pace with wage growth. So they're not many huge red flags here. I think the other thing to point out is that sentiment sometimes is at odds with the reality of consumer financing ability, in that what is important to ask when households take out debt is what their ability to repay it is. And here, the debt service repayments for U.S. households as a percentage of their disposable income are far below levels that we saw, for example, during the financial crisis, where they exceeded 13%. We're now at about 10%. This is not as low as 8% in 2021, but of course, there we had a gap between what people were spending money on and, of course, the influx that they got because of the fiscal stimulus that was so generously dispersed.
Sweta, the debt level comment that you just made really kind of sparked a note with me, because even though you are seeing those debt levels kind of in line, the personal savings for a lot of Americans has just come off of a cliff as a kind of share of income. Now, to be fair, Americans are not known for their saving abilities to begin with, but I'm curious if that actually becomes some sort of early tell on the consumer. We were discussing it earlier on the show about what that tell might actually look like. My vote was Coca-Cola earnings, but what other ways can we kind of monitor outside of the actual economic data when that consumer resilience turns?
So it's true, US savings are currently less than half that of EU savings rates. And that, I think, is a function of the very robust job market. So, I mean, it's quite simple, is that as long as Americans have jobs that are continuing to pay better than they did in the past, because even as inflation is moderating, price levels are still higher today and wages are still higher today than they were a year ago. So as long as that happens, US consumers feel happy to spend. That said, they're not spending indiscriminately. So we have, for example, Walmart, biggest retailer in the US, calling out their favorite phrase, which is a choiceful consumer, which is a consumer who is shopping more frequently, hunting for deals, hunting for value, and the average ticket is slightly moderating. And to that extent, I think the cost of financing is playing a bit of a role in that 40% of US mortgages originated in 2020 and 2021 at rock bottom rates. And of course, those people are now stuck and unable to refinance, perhaps unable to move, and that creates a little bit more friction and perhaps, a sense of lost opportunity when it comes to spending, which is, again, I think, one of the reasons for relatively depressed sentiment versus the actual reality, which is a bit more buoyant.
But does sentiment even matter here? I'm curious that if you do start to see some sort of weakness in the labor market that isn't yet widespread, for example, and that's something that we've been waiting for years in terms of recessionary risk, do people then still spend regardless in recessions, just kind of change to cheaper products, for example, more generic products at a place like Walmart, for example?
So I think sentiment does matter because it is sort of sentiment as well as the labor market, I think, will dictate what happens with the U.S. consumer in 2024. And you're absolutely right. When there's a recession, people still spend, but not in the same manner. And their spending skews much more towards staples than it does towards discretionary items. Of course, one of the big stories also from 2023 is this shift in U.S. consumer spending away from goods towards services. So people going out, traveling, theme parks, holidays, hotels. And in fact, all the big five hotel operators who have reported results have reported a very robust pricing environment. These are not companies historically that have had significant pricing power, yet they do now because demand far outstrips supply in their businesses. There's some data actually from Bank of America that suggests that card spending on services is actually ahead of 2019 levels, which suggests that shift in the economy as people try to make up for lost time on travel, et cetera, is still very much intact. That is an area that could be vulnerable should we start to see cracks in the labor market, which we don't at the moment.
Good morning, it's Guy. If people are going out, they generally want to have clothes to go out. So that takes me to the kind of the clothes story. We've been debating this morning the Shein story. We're trying to work out whether that's a good get for London if it gets it. But A, I'd be interested in your take on that, and B, I'd be interested in your take on, do you want to go up in value or down in value right now? If companies are merging or making acquisitions, do you want to be at the lower end of the value story or the upper end of the value story? It's interesting that Campari is looking to make acquisitions going upwards rather than downwards.
So maybe taking the second question first, I think you want to be either at the low end or at the very high end. What's definitely getting squeezed is the middle. So people are trading down on the one hand, and then on the other hand, you've got, for example, luxury companies where in the fourth quarter of 2023, they actually reported a sequential acceleration with the US consumer after sort of 9 to 12 months of very weak anemic growth. So again, this is a definite polarization where anyone in the middle is getting squeezed. Yep. So you either want to be up market or down market. I mean, as for Shein, I think it's quite interesting. If the reason for them not wanting to list in the U.S. is regulatory burden, then I would question how deep the pool of capital that they can access within the European markets can be, given that European regulators have even more stringent regulations when considering ESG standards in the fashion industry, which of course the homegrown industry has learned to live with. But for someone like Shein offering rock bottom prices with perhaps not as much transparency on its supply chain, it'll be an interesting point to see where exactly they can derive that improvement.
What are the lessons we can learn from companies like Boohoo, et cetera, who are in similar markets and the ride they've had over the last few years? Can I draw a line between one and the other?
I mean, at this point, I think the lack of granular detail makes it hard for us to necessarily sift between the two. But the lesson very much is that supply chain transparency is very much needed, not just by the regulator, but by investors as well, because that can be a key vulnerability in these investments that make them quite risky versus better capitalized, larger players that have that transparency and are able to offer us audits on their supply chain.
Sven, it's always great to catch up. Such a varied area of interest at the moment in all of this. Sven Ramachandran, fund manager at Artemis, thank you very much indeed. We're going to be talking to the CEO of Campari. I think it's tomorrow morning. We get the numbers a little bit later on today. You guys aren't fans of Aperol?
Don't out me.
Okay.
As not an Aperol drink, not my thing. But you know,
bitter.
There are other things on offer,
like margaritas, for example.
So Chrissy is scouring London. If anybody knows of a good margarita bar in London, Chrissy is definitely interested in that.
I need one. It's horrible. Look, I grew up in Dallas, Texas. Tequila was the drink of choice, simply due to proximity. And as I went higher and higher north and away, the margaritas got worse and worse. And
yes.
I'm hoping.
So you're not playing to London's strengths here with this strategy.
I know, but I'm hoping maybe London as kind of international hub will prove me wrong in some way.
Right,
High expectations.
Let's quickly check on the markets, shall we? We're up 0.1% on the London market. That's fairly decent against the rest of the market, which is flat. Stock 600 is flat. The CAC 40 is flat. The DAX actually up by 0.2%. Coming up on this program, we'll pivot to geopolitics. Sweden clears the final hurdle to join NATO. We will bring you the story next. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. Markets are doing, at an index level, absolutely nothing. But there are things to talk about. There's a number of stocks that are worth watching. EQT is certainly one of those. I'm going to point out that defence stocks continue to rally. We're going to talk about this in just a moment in more detail. We'll talk about the Sweden story. But Rheinmetall is at a 52-week high. Saab, which is part of this Hungary story, at a 52-week high. There's a story out as well this morning talking about the fact that Europe is looking maybe to do more defence procurement at home rather than buying in the States. In theory, that is a further tailwind, and it'll be interesting to see kind of as we develop that strand as to kind of what numbers we're going to be looking at and how it gets funded. But I think the tailwind for defence stocks continues.
I think that's a really interesting story that we'll pick up on perhaps in a moment, but with Europe saying it wants to perhaps in the future not buy quite so much in the United States. You know, is this in preparation? This might be under any administration,
Trump,
but is this perhaps in preparation for a Trump presidency where that might be one of the cards Europe has to play?
Yeah. So defense budgets in Europe increasing naturally, but even with a Trump presidency, the United States budget for defense also increases, especially if you start to have a more GOP control over the House or the Senate, for example. Suddenly your defense spending goes up even more than it already is. Not to mention, by the way, the tailwinds around the conflict in Israel and between Israel and Gaza, and then the conflict in Ukraine as well. So you are starting to see so many different flashpoints that, in theory, create tailwinds, and yet nobody seems to have the same kind of momentum in defense stocks that you do in other sectors.
European defense stocks have had a really good run, and you maybe move it out a little bit further into stocks like Rolls-Royce. That stock has been up absolutely massively. Airbus has been on a really big run as well. It's interesting to see that Boeing getting, I think Dave Calhoun is meeting the FAA. I think it's tomorrow, a further ticking off in a latest report. That stock has continued to struggle. Airbus has been the beneficiary of that. Watch out for a potential United story. But I think European defence stocks since the war have had a significant tailwind. The numbers, we never talked about Saab, we never talked about Rheinmetall. BAE Systems has been on a really strong run as well. So these stocks have had, and they continue to be front and centre in all these deals that we see as well being done in terms of the geopolitics.
We certainly talked about BAE when those numbers came out, didn't we, with the tailwinds there?
Yeah, and you're talking about European defense. I'm just pulling up a chart of Lockheed Martin as well. You mentioned Boeing. Lockheed Martin, the shares have just been going down in the last 12 months or so. That would be counterintuitive to the entire thing that we're talking about here.
Yes, and maybe because the US maybe has got budgetary constraints, but actually, as to your point, actually the budget still has been rather sort of substantially ring-fenced. But I'm talking more specifically about European companies. Europe has underinvested in its defence sector. Europe has underinvested, you could argue, in its armed forces. That is where the catch-up trade is more relevant.
Okay, Sweden is set to join NATO within days after Hungary's parliament finally approved Stockholm's accession. The go-ahead comes months after the Nordic country submitted its membership bid alongside Finland in response to Russia's invasion of Ukraine. For more on this, we're joined now by Bloomberg's Oliver Crook, who is in Berlin. It's been a complicated road for Sweden to get this NATO membership. Finally, the final hurdle has fallen then, Ollie. How significant is it then for Stockholm? I mean, this overturned, well, the invasion of Ukraine overturned years of policy around defence for this country.
Absolutely. Almost 2 years to the day since the invasion of Ukraine by Russia. Now Sweden is set to become the 32nd member of NATO. And as you say, Anna, really breaking from precedent for the nation. And really, you know, there were these hurdles initially by Turkey and then by Hungary. It really seems that the path to NATO is paved by fighter jets, maybe appropriately, because it was the sale of these to both of those countries that really basically clinched it in the end. But really, as we say, in the next couple of days they can join. And Sweden really ends their sort of military non-alignment through 2 world wars. And really, they haven't been in a war since 1814. So really a shift on the perspective, on their perspective from NATO, where they were initially quite skeptical, but that has obviously changed. Strategically, as you can see on the map there, I mean, it's a huge part of the Baltic Sea. They have very advanced submarines. Guy, you were talking about Saab, the defense contractor, which not only hit a 52-week high, has hit an all-time high yesterday, will be part of the story here. And of course, financially, while Finland has that huge border with Russia, Sweden is about twice the size of the economy. 2% of that GDP goes to NATO defense spending now.
Let's talk about how this sort of translates into the wider European story. Macron, the French leader, trying to rally support around Ukraine. There is this belief as well that Europe needs to do more of its own defense procurement. These two things are slightly antagonistic, but there is a view now that we need to source as well ammunition, etc., from outside of Europe. Can you kind of pull all the various strands together? What did Macron succeed in doing with this meeting?
Right, so really the part of this meeting was in order to get more goodwill towards Ukraine. The issue that there is in Europe is that there's not really goodwill lacking, there's ammunition lacking, and there's capacity to actually produce that ammunition. So one of the things that was discussed at the meeting, which now appears to have gained favor with the French and with the Dutch, which they were initially resistant to, which is buying some of these artillery shells from outside of Europe, which underlines some of the difficulty that they've got in terms of getting the volumes up. However, one of the things that really I think you're going to step away from this with, and really the headline from this meeting, is what Emmanuel Macron said in talking about the possible deployment of troops in Ukraine at some point. Have a listen to Mr. Macron.
There is no consensus today to officially, openly, and with endorsement send troops on the ground. But in terms of dynamics, nothing should be ruled out. We will do everything necessary to ensure that Russia cannot win this war.
And you listen to the president of France there, and really hanging over all of this is the discussion in the United States, which is waning support publicly for support of Ukraine. Of course, the bill is still stuck in the House, and Biden today is calling congressional leaders to the White House to try to get this through, to say nothing of what you've been mentioning, which is the possible presidency of Donald Trump, who has been extremely skeptical of NATO. And it's not very clear at all what that means in terms of possible policy, but it means potentially a more leaky American security umbrella over Europe.
Ollie, when we're talking about the security umbrella, though, to what extent are military purchases, deals around fighter jets being used as political capital, political currency when it comes to navigating what the future of NATO looks like and other armed alliances? Just walk us through that dynamic.
Yeah, so listen, again, I think there's just this realization that the United States may not be able to be relied upon, and for Europe, that comes with some major consequences. So we saw a draft proposal from the EU Commission about what their defense policy will look like in the coming years, and I'm just going to read you one passage from it, which I think just really encapsulates this. They say, the geopolitical developments point to a compelling need for Europe to take increased responsibility for its own security and to get ready to effectively address the full spectrum of the threats it faces. What does that actually mean in terms of policy? We expect the Commission to release this in the next couple of weeks. It means they want to source within the EU 50% of all of their sort of defense systems. And as we've just highlighted, they don't have the capacity right now, so that is going to be a very difficult thing to ramp up. And around this, you hear a lot of the same language we've heard across a vast array of issues within Europe. Raw material policy, energy policy, all of these things that now Europe is scrambling to get in place over the next couple of years, trying to cut out dependencies and to be able to stand on its own 2 feet from a security standpoint.
Oliver, thanks very much. Oliver Crook joining us there with the geopolitics, and finishing there with a look at the transatlantic geopolitics, a story we picked up on a little bit earlier on.
Basically, Turkey got fighter jets, it got F-16s. Hungary got the Gripen fighter, which we just saw there. Like, it's fascinating, and ultimately this comes down to money and armaments, and you want this, I want that.
Yeah, absolutely, and we saw that. And then with the transatlantic deal, you wonder if this is, as we said earlier, the Europeans preparing for a change of presidency, perhaps, and what that might mean. Yes, ramping up defence spending, but in particular, ramping up defence spending from within Europe.
Within Europe, and they also have a little bit of a credibility issue when it comes back to the U.S. We had the most senior military official join us on the program, I want to say 2 weeks or so ago, talking about the fact that the U.S. needs NATO just as much as Europe needs NATO. And they're really trying to talk about reframing that argument to whoever is the president in 2025.
Okay, should we have a little look at what is coming up today? Because we've talked a lot about geopolitics, but in terms of the market picture, we're not moving anywhere in a hurry, waiting for some key data points. One of those is going to be Euro area monthly credit data. Oh, yeah. That's due out. Guys, very excited about this point in particular. That's due out shortly. 1 o'clock, we get Nigeria's central bank, its rate decision. 1:30, US durable goods orders. 3 o'clock, US consumer confidence. So there's some US data in there as well. Macy's and Lowe's releasing their fourth quarter earnings a little later. That's going to be interesting. And of course, it's the New Zealand rate decision. It's not on there because it's not strictly Tuesday. It's Wednesday, but it's early hours of Wednesday for us.
Macy's looking forward to another tell on the consumer.
It all comes back to the consumer. But why are you so interested in the monthly credit data?
Because it's ticking up. And if if the credit impulse is starting to become less bad,
Yeah.
there's a reason maybe therefore for the ECB, it gives the ECB time maybe to pause.
Yeah, it's all about that pause, the length of that pause. We've talked about that a bit this morning.
We have, although he's excited about the credit data. May season lows is still it for me. I love a corporate earnings story. We're going to dive into it.
Yep, we will. That's it for markets today. The Pulse is up next. They'll keep an eye on these markets for you, get you ready for that macro data shortly. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London with the conversations that matter.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Adding a 0.1%. Let's flip the board and look cross-asset then. The currency of the moment is the Japanese yen on the back of the strength that came through on the inflation picture. A little bit of gain coming through, slightly above the estimates. And again, you saw those yields on the front end, on those two-year yields, up to the highest level in about a decade in Japan. Again, as markets start to reassess where the BOJ goes in terms of ending its ultra-loose policy. Is it March? March is possibly now a live meeting. Currently, you're looking at 150 on the Japanese yen, currently up 0.3%. US two-year currently at 468. The yields had been up a little bit yesterday on the back of a Treasury auction. Yields currently down 2 to 3 basis points. You are seeing a bit of money moving into the US Treasury market so far in the market session this Tuesday. Brent seeming to find some kind of floor at $82 a barrel, 82.45 right now, just down 0.1%. And Bitcoin, 56,297, just below 57,000. It crossed through that level for the first time since about the end of 2021. Those flows into those crypto ETFs have been pretty pronounced, and you're seeing some further upside there, gains of 3% for Bitcoin. Let's get back to the markets, though, in terms of what's happening on the inflation front and the expectation around the Feds. Let's bring in Lucy Baldwin, Global Head of Research and Equity Advisory at Citigroup. We'll also get Lucy's views on the Japanese markets as well. Lucy, thank you very much for joining us in the studio this Tuesday morning. Let's start with the expectations then around the Fed pricing as we lead up to that inflation print on Thursday. The expectation still markets pricing just under 4 cuts from the Federal Reserve. The dot plots, of course, had forecast 3 cuts this year. If we get a hotter than expected print when it comes to PCE on Thursday, how vulnerable are these markets?
Good morning, Tom. Thanks for having me. Yes, big question. And from our perspective, as you say, we've gone from one extreme where we were looking for 7 cuts at one point, all the way into now 3 cuts broadly being priced by markets. Our view is really that the Fed is going to be much, much more cautious, and that the risk here is that you continue to see this fairly hot data in the US, particularly driven by services inflation, hot labour markets that are really still very tight in a number of places. So our expectation is that you're not going to see cuts coming through till June. However, we do take the view that you're going to see around 125 basis of cuts, and that's predicated by a technical recession that we expect to see in the US as we go through.
So it's later, but it's more cuts. And am I right in thinking 125 basis points of cuts then by the end of this year, but you don't think they start until June? And you still have flagged a recession in the US. What gets us to a recession in the US, given that we are seeing on a number of data points continued resilience in that economy?
Yes, and we're getting that question a lot, as you might well imagine. And as you say, we also had quite an optimistic view, last year in many, many ways. And we obviously saw great data coming through last year into the start of this year. Why do we think it's going to slow? Really, there's 3 things that we think are going to slow in the US dynamic. One is that rates are actually going to bite. Like, the longer these rates stay at these levels with inflation coming down, the real rates obviously going up, that's really starting to bite. We see those cracks in parts of the consumer, in parts of the real estate market coming through, and the longer it stays like this, the more it's going to bite. Really, we got it a bit wrong because we thought you'd see this recession earlier. We thought you'd see it last year, like many people.
You weren't alone. Yeah.
Exactly. And ultimately, the consumers, the corporates, they locked in, they turned out their debt, and it's taken a lot longer than we'd have expected to manifest. The second thing, really, is the fiscal impulse we think is going to be an awful lot less, not just for the US, around the world. Despite, obviously, half the world's population going to the polls, that fiscal space just isn't there to really stimulate to the degree we obviously saw coming out of the pandemic. And then the third point is just this services piece, right? Coming out of the pandemic again, you saw this big rotation out of goods into services. Everyone went out to their favourite restaurants, off on holiday, and you saw services running incredibly hot around the world, but particularly in the US. And we think that is really going to be moderating. So that's what's giving us the conviction of the slowing this year. Yeah. And that's why we're below consensus for growth in the US and also globally. But what is it about that, really, that triggers us into recession? And for us, that's a real debate, and it's quite a fine line, Tom, candidly, is around what is making that slowdown dynamic come through from a jobs perspective. Do you get the conventional demand destruction, people losing their jobs, that side of things triggering a recession? Or can you see the US labour market, as Team Soft Landing believe you can, expand to the point that enables you to see wage pressures moderating without unemployment going up, and i.e. participation rates in cohorts of the market increasing, but also the immigration dynamic that we're seeing in the US, expanding that supply of labour, and can those things enable this soft landing of the plane? But we think it's just too early to call that victory over inflation.
Because that is, you're right, that is part of the debate, because one view is if you start getting cuts from the Fed, that's because the economy is doing badly. That's because the economy is moving into a recession, and actually cutting from the Fed in that environment is going to be worse for these equity markets than what we're currently seeing. And of course, the earnings story is part of it, AI is part of it, but they have powered through in the US, particularly the strength that's come through across the equity markets despite these higher rates. How do you land on that debate?
Well, as you say, there's this bit of a Goldilocks expectation out there that is forming, that you can see quite a big magnitude of cuts, but without any real sort of slowdown in terms of growth dynamics. And that, of course, is the challenge. So, you know, if you think about our view of the S&P, obviously last year was a phenomenal year for the S&P. 27% growth. That was 60% driven by the Magnificent Seven. As we know, we've come into this year and our call has been this sort of broadening out of earnings growth.
So it broadens out, it doesn't top out for
Correct.
the S&P.
We do still see some upside, although our base case, the upside is really not significant.
5,100 on the S&P.
Exactly.
But the bull case is 5,700.
Correct. And to get there, you've got to see $260 of earnings. You've got to see 23 times of earnings, so a multiple expansion. Now, look, for us, valuation isn't everything here at these levels. It's absolutely fair to say that in 90% of history, the S&P has been cheaper. So valuation is definitely at the high end. It's in that 10th decile from a valuation perspective overall. But when you use that looking forward, it's very rarely the right proxy to think about returns in the next 12 months. What matters much more is earnings momentum, which is a big theme, obviously, and, of course, flows and the positioning side of things in the market, as well as the rates piece. So we wouldn't use valuation as a reason to sell the S&P here. And, in fact, we do see in that Goldilocks scenario some quite substantial upside still to come. But, yes, we do think there's this broadening out thesis that needs to come through as well, Tom.
OK, and that earnings strength, we've seen that in the US, and one of the other developed markets where we've seen it pronounced is Japan as well, and stocks there, and the Nikkei up about 40% in the last 12 months. We had the inflation data out of Japan coming in slightly higher than expected. That maybe brings forward the move from the Bank of Japan to end that ultra-loose monetary policy. Does that fade? Does that dull the story for Japanese equities, or do you still want to be adding in terms of your portfolio management?
Yes, we are still pretty bullish on Japanese equities. We still see 15% upside from here. And
further 15% upside.
From here. And as you say, quite rightly, Tom, the interesting thing with Japan is there had been that expectation today that we'd drop below that 2% threshold, having been there, I think, 2% or more since, obviously, March 22. And was that going to kill the story? This thesis of inflation coming back and, as you say, lift off then potentially for the Bank of Japan from as early as March, April this year. And our view is that that thesis has got room to run. And the reason for that is when you think about the Japanese equity market in particular, right? If you go back to, as you say, 30-odd years to 1989 to the last sort of peak, when you looked at it, it was an incredibly expensive market optically. That is no longer the case. So that valuation adjustment from 30-odd years ago has absolutely happened in Japan and is a very compelling valuation story now. Secondly, and quite critically, the earnings story is incredibly strong. If you look at Japan corporate earnings, from the mid-2010s even, there's been this really remarkable recovery that's kind of gone under the radar screen to some degree, in the sense that the reform agenda in Japan has really transformed things. And much more recently as well, you've seen use of cash, you've seen balance sheet discipline, you've seen share buybacks, you've seen dividends, etc. And that has meant that Japan has actually been, from an earnings growth perspective, over now quite a long period of time, a remarkably good story in a global context. And I guess the third piece of that is when you look at the economy, all of that has happened while inflation has obviously been challenged. Now we've got a bit of inflation back. We think this story can actually get even better from here, and that's going to support the earnings growth, and in turn that can enable further re-rating from a valuation perspective. Okay. Hence our confidence that it's not too late and you can indeed still party like it's 1989.
Love it. Still party like it's 1989, but with better fundamentals, arguably. It's not a flash in the pan for Japan.
Absolutely.
Lucy Baldwin, thank you very much indeed on the case for Japanese stocks, and also, of course, the view on inflation, the trajectory there, and what that could mean, of course, for Fed policy going forward. The case there, the view that you still are facing a technical recession in the second half of this year for the US economy. Lucy Baldwin, Citigroup's Global Head of Research and Equity Advisory. Coming up is London Calling for Shein. We take a look at why the fast fashion brand is preparing for not making the cut in New York, what that could mean for London's markets. That is next. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back. Now, Bloomberg has learned that fast fashion company Shein is considering the possibility of switching its IPO to London. That's reportedly because of hurdles to a US listing. Let's get the details then and bring in Bloomberg's Sophia Horta-Costa for the latest on this. Is this then, Sophia, a long-awaited win for the UK markets?
Potentially. I mean, being a choice, even if your second choice or third choice is better than being no choice at all.
We would take it at this point.
We'll take it. This is not a tech company, but it's a big name, and it's a name that's trying to kind of make inroads in the UK. It bought Misguided last year. It tried to buy Topshop a few years ago, losing out to ASOS. It had a pop-up store on Oxford Street. So really kind of building the relationship here. We know that the founder met with some city executives when he was here in December. If this is a win for London, and there's a lot of ifs here because the US is still first choice. There's regulatory hurdles, but also political pressure. Marco Rubio being one of the senators that's pushing against us because it is, even though it's not based in China, it is a Chinese-founded company. And that's not a very politically popular thing to welcome into New York at a time when the US is preparing for elections. But this would be a big win for London. It would be a big company. I was calculating, even at the lowest valuation, it would be about the 17th biggest company in the UK were it to list here at current valuations. So, and it's, it's a big name, it's a big brand. I'm interested in why Shein's not looking at Hong Kong, because that would be normally the second choice if Chinese-founded companies can't get New York. So if London starts to be an alternative to Hong Kong, that's another story altogether.
Okay, that's one worth digging into then, potentially. Meanwhile, here in the UK, we're seeing a little bit of easing in terms of grocery prices, at least prices in shops. What are the dynamics that we're seeing at play there?
Slight race to the bottom in terms of price, so it's becoming incredibly competitive among grocers, supermarkets, really wanting to get customers through the door, and that's more important for them right now, to gain market share than to get customers to spend more. So we did see see a bounce back. Valentine's Day did help. There was a slight discounted Valentine's Day, but it did help versus January. But this is adding to inflation in all seriousness, adding to evidence that inflation is coming down. The numbers for January were lower than expected. Retail sales picked up from a very, very miserable December as well. So this is good news. I mean, things are moving in the right direction. We did actually see a little bit of a market reaction with gilts outperforming bunds and treasuries, and that might be because of the disinflationary story here in the UK.
That's really interesting. Yeah, you're seeing a 3 basis point move lower at the front end and on the 10-year here in the UK on gilts on the back then possibly of that slightly softer shop inflation coming through for the UK. Sophia Horto-Acosta, thank you very much indeed. With the eco data in terms of the inflation trajectory and of course the news around Shein potentially looking at the UK as a listing destination. Coming up, we're going to discuss commercial real estate and the risks to the euro. We will speak to the managing director of the European Stability Mechanism, the institution which protected the currency during the financial crisis. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I did that all in one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
I wouldn't have a general view on it. We monitor it also as ESM because obviously we are there to ensure financial stability or prevent a crisis. So we obviously follow this. But as of now, I think this issue, which was on the radar since the interest rates went up in all countries, has not materialized spectacularly.
So you wouldn't characterize it as a crisis right now, but you are focused on this risk.
Exactly.
Okay. Does there need to be more transparency around how German lenders account for their exposure to commercial real estate?
I wouldn't focus on German lenders. I think the issues everywhere, and we need to have a global view on this. That's what we do. As the safety mechanism or the one that safeguards the euro area, we look at all the countries because we are a united Europe, so you have to have all the interlinkages also.
But for now, you are confident that you have the clarity and the transparency into the linkages between CRE, commercial real estate, and banks more broadly then across the Eurozone. You have that lens, do you?
We look into that, and we're not the only ones.
Sure, okay. So talk to us about why you are here in London then. What is the purpose of your visit here? What are you trying to achieve?
Well, the ESM has bonds outstanding and refinancing to the tune of closely to 300 billion euro. So we refinance that on a regular basis. And we are here in London because it's an important financial center, and also because the United Kingdom has been a steady investor in the ESM since the beginning, and it's increasing over time. As we speak, more than 20% of our bonds are held by UK and Switzerland. It gives you an idea of the size.
Is the appetite still there in this environment?
It's quite good, and we have been on the market since the beginning of the year as ESM, and it was quite positive.
Okay. Italy's government hasn't yet ratified the ESM reform. Do you have a time frame? Do you expect that to happen before the European elections?
Well, it can mechanically not happen before the European Parliament elections because it has been presented to the Italian Parliament in December with a negative vote. So for the Italian constitution, you need to wait for 6 months before you present it again. And so I think there's still a lot of explanations to do in Italy. And also, in fact, in the first year in office last year, I have visited all the member countries of the euro area, which are the members of the European Stability Mechanism, to see how the ESM can best respond to the needs that we have today. We have different types of crises today than those that triggered the existence of the ESM, which was the sovereign debt crisis. And at that time, we had in mind such types of crises. And now we've had COVID, now we have the war in Ukraine and geopolitical instability, to say the least. Now we have the war at our doorstep. So obviously, everyone is looking into how different institutions can best respond.
Yes, because the Italians, of course, it's the stigma around austerity, the linkages between austerity and the ESM that is a political concern there. You mentioned the war in Ukraine. Olli Rehn, of course, formerly a consequential role across the Eurozone and a former EU Economic Affairs Commissioner, has said the ESM should be a plan B in terms of Europe's assistance to Ukraine. Would you be open to that?
Now, first, you have to realize that our mandate is to help the 20 member states in the euro area. We cannot help a country outside our remit. But obviously, we could indirectly help if some countries have issues that are triggered by the war in Ukraine or would have problems accessing the market, we could try to help them, and not only if there's a deep crisis, but also to prevent a crisis.
Okay.
So we can help our members.
Pierre Gramegna, thank you very much indeed. We appreciate your time this morning. Managing Director of the European Stability Mechanism. Much more to come. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And, you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. Now, Japan's two-year yield jumps to its highest in more than a decade. After inflation comes in hot, traders now bet there is an 80% chance negative rates will end by April. Shein could consider listing in London if the fast fashion retailer doesn't get approval for a US IPO. Plus, French President Emmanuel Macron says sending Western troops to Ukraine cannot be ruled out as Sweden gets final approval to join NATO. Good morning and welcome to The Pulse. I'm Tom McKenzie here in London. Let's go to that story then. Sweden is set to join NATO within days after Hungary's parliament finally approved Stockholm's accession. The go-ahead comes months after Sweden submitted its membership bid alongside Finland in response to Russia's invasion of Ukraine. For more on this, I'm joined by Bloomberg's Oliver Crook, who's on the ground for us in Berlin. Ollie, it has, to say the least, been a complicated road for Sweden then to get to this point. How significant is the extension to NATO for Stockholm and for the alliance?
Right, complicated and long, right? This is almost 2 years to the day since the invasion of Ukraine by Russia, and this is something that was held up initially by Turkey and then by Hungary, and it seems that the path to NATO is paved in, perhaps appropriately, fighter jets. It was agreements to sell fighter jets to both Hungary and to Turkey that seemed to finally clinch it, and now Sweden will be poised to be the 32nd member of NATO in the coming days, and this is significant because Sweden has historically been quite skeptical of this sort of alliance politically, but also within the population. That obviously changed 2 years ago, and it also changes a sort of policy within Sweden of sort of non-alignment militarily. They have not been in a war since 1814, so really a significant change there. And when you look at it geostrategically, look at the map there in front of you, it's a huge player in the Baltic Sea. They have very advanced submarines, home to Saab, which makes the fighter jets that Hungary wanted to get their hands on. And so from that perspective, also significant. Saab, which by the way hit an all-time high yesterday, probably in part because of all this, but also financially, right? Finland has got that huge border with Russia. However, Sweden's economy is twice as big, and that means 2% of that, of GDP, eventually will be going to NATO defense spending now.
Okay, and as we say, this was the catalyst, of course, was Russia's invasion of Ukraine, and we've been hearing Macron convening European leaders in Paris to kind of try to rally support for Ukraine. Did he ultimately succeed?
So I think he's managed to rally, additional goodwill. The problem that there is here with Europe and Ukraine is that there is no shortage of goodwill. What there's a shortage of is ammunition and capacity to actually produce that ammunition. And that was really kind of at the heart of the question there. Maybe they're going to source some of it from outside of Europe. It seems that that idea is getting more traction. The Czechs have proposed this, and now the Dutch and the French say they are on board. But I think the headline for many people will be what Emmanuel Macron said about the potentiality of troops on the ground in Ukraine. Have a listen.
There is no consensus today to officially, openly, and with endorsement send troops on the ground. But in terms of dynamics, nothing should be ruled out. We will do everything necessary to ensure that Russia cannot win this war.
So Emmanuel Macron saying nothing should be ruled out, and that is in part, we have to assume, because of the big question that's hanging over everything, the United States, you still have tens of billions of dollars in aid stuck in the House that is not making any progress. Biden is convening congressional leaders today to try to get that through, but then there's also the other big question, Tom, that is the potential for a Trump presidency who has spoken very disparagingly about NATO. What that means in terms of policy is not entirely clear, but it could mean a more leaky U.S. security umbrella over NATO.
Okay, Bloomberg's Oliver Crook with the latest there on the question of NATO and, of course, that support for Ukraine, that ongoing support. Ollie, thank you very much indeed. Coming up, we're going to be joined by the CEO. We're going to switch focus and joined by the CEO of Technogym. We're going to explore how AI is changing the health and wellness sector. That is coming up. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, Hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome back. Now, Technogym shares falling close to 6.4% this morning in Milan, the most since July 2022, after banker Akros cut its recommendation to sell on expectation of disappointing results for 2023. It comes as the company tries to stay at the forefront of innovation in health and wellness, including, of course, the boom in artificial intelligence. There's also something of the Paris Olympics to be thinking about as well. Joining me now is Nerio Alessandri, the CEO and chairman of Technogym, of course, the founder of this business. Nerio, thank you very much for joining us in the studio. Let's go to that point then, around the demand, around the outlook. What are you seeing for 2024? How is the demand picture shaping up for you?
Thank you. Yes, we are very positive for this year because the wellness, the healthy lifestyle, the prevention is the new priority for everybody. Technology is a leader in the fitness, health, and sport smart equipment in terms of ecosystem. And thanks to the artificial intelligence today, we have the possibility to customize and personalize the program. And technology is a personalized wellness lifestyle in the holistic approach in terms of nutrition, training, precision training, and mental approach.
So the downgrade that we saw today is pegged to the idea that you're going to have to spend more on OPEX, operational expenditures, in order to stay ahead when it comes to innovation. Is there more that how much spending are you going to have to put aside? Is that a fair view on what's going to have to unfold for you in the business to stay ahead in innovation? Are you going to have to step up that level of spending?
Yes, technology means the long-term approach in terms of a sustainable profit and sustainable growth. We invest a lot of money in the last 2 years. It's the record for technology in terms of investment in digital transformation, in Internet of Things development.
That level of investment continues, or you're going to have to go above that?
No, we invest in the last 2 years. This included, but now we would like to capitalize the investment. We would like to create the future. We build the future, and now we have a very, very positive prevision for the future.
Okay, very anecdotally, after COVID, I've seen a lot of friends getting rid of their running machines or their cycling machines at home and getting outside. They want to be running in parks, they want to be running through London. Are you seeing a shift in terms of that demand for your devices?
But today the new approach is the hybrid, not only at home, not only in the club. Means technology anytime, anywhere, wellness on the go. Means variety. People, they like the variety. Sometime at home, sometime during the work time, in a club, in the free time. It depends. Because it's the culture. The wellness is the culture. The wellness is the mindset. The wellness is the education in terms of prevention, healthy lifestyle, in terms of sport performance, in terms of energy, but first of all, in terms of entertainment lifestyle.
You've got a big exposure here in the UK market. What are the other priority markets for you, the other growth markets as you look ahead this year?
Now we have amazing growth, amazing opportunities in Middle East. Technology signed a contract with NEOM. NEOM is the new city, the smart city, the wellness city. We have many projects in Middle East. There are all in Saudi Arabia 800 new hotels in the next 5 years. But still very good also the Asia Pacific, because there is the new opportunity in terms of new countries. India is amazing new opportunity, India, but in the next 2-3 years also Africa, Nigeria, Angola, because the North Africa, because Africa is the new frontier for everybody.
Okay, interesting. There's a lot of components that go into your devices.
But US still the biggest market.
Okay, US still the biggest market. When it comes to inflation, input costs, what are you seeing there? Where is the stickiness most acute when it comes to all the inputs that go into your machines?
Okay, we manage the price because we manage the value for money approach. Technology is quality, is premiumness, and in the home we are luxury living. The pricing, we have pricing power, and we don't have problem in terms of pricing. We have, first of all, problem, in terms of opportunity, about go-to-market. We need to build the future. Building our future is our must, because we need to create the culture in terms of prevention. Exercise is medicine, and we need to share with the healthcare system in terms of health is wealth. Health is good for companies to increase productivities. Is very important for government to reduce their cost, but is very important for people to increase it, to improve the quality of life.
You still have pricing power in this environment.
Exactly.
You can put up prices further from here if you need to.
First of all, means education, and then the price. First of all, is to create the needs, to share the value added with operators, with end users, and then is the price is important.
How are you integrating AI into your business, maybe to create efficiencies, but also into your products?
Yes, we started 30 years ago to develop software, the first training software. Today we have more or less 25 million people inside our My Wellness Cloud, is the ecosystem, and 55 million of people, they use technology every day. 55 million, they use technology every day. And then our goal is to connect in the ecosystem wellness connected experience.
Okay. When it comes to the Paris Olympics later this year, this summer, going to be held in the French capital and around other regions of France, how much of a catalyst could that be for your business, to the top line?
Yes, we are technology is official supplier for the last 8 edition, and then also Paris 2024. 13,000 artists will use technology in July, August. For us, it's very important, like in the automotive for the Formula 1. The Formula 1 for us is the Olympic Games. We have feedback from athletes, champions. We have the lab, thanks to this experience, because 26 training centers in Paris, they use technology for 4,000 smart equipment. And then we have relations with doctors, sports doctors, physiotherapists, federation, for 220 countries.
Do you see a sales spike after and on the back of the Olympics?
Not
Are you
the
expecting
spike in the short term, because the Olympic Games is the opportunity for the long term. Okay. Because it's not the consumer style. It's the business to business style. But when we have the endorsement from the champions around the world, the credibility of the brand is very, very important.
Okay, Nerio, thank you very much indeed for your time. Certainly not lacking energy this morning. Nerio Alessandri, CEO and Chairman of Technogym, of course. Now, switching focus as the WTO meets in Abu Dhabi this week, the EU's trade chief says the world needs to preserve rules-based trade. Valdis Dombrovskis spoke exclusively to Bloomberg from the conference.
We are currently certainly in a more conflictual geopolitical situations than we were before. There is growing tendencies towards protectionism. We risk economic fragmentation. So we need to address all of this, and therefore we need to preserve the role of the WTO and rules-based multilateral trading system.
Okay, European Trade Commissioner Valdis Dombrovskis speaking to Bloomberg a little earlier. Meanwhile, the head of the World Trade Organization says global commerce is performing weaker than forecast amid multiple economic headwinds and a political tilt towards protectionism. She was speaking at the WTO conference in Abu Dhabi. Let's bring in at this point Eric Martin, who joins us from Abu Dhabi with the latest. Eric, good morning. Thanks for joining us. What have people been talking about at the conference? What have been the hot topics? What is grabbing people's attention? Is this an organization that can ultimately be reformed?
Good morning, Tom. Well, that is the big question. We've seen a strong push by the U.S. as well as other governments to try to update the WTO and to keep it relevant. This was an organization that for a number of years hadn't seen a new agreement completed. Everyone is very excited about an agreement that is set to enter force once it reaches about 2/3 of WTO members enacting it, which is on fishing subsidies, trying to preserve the fishing stock in the ocean, which the WTO chief has mentioned is 50% overexploited at this point. So thinking an issue that combines both people's livelihood for hundreds of millions of people as well as the environment, but really trying to see how do you, in an era in which the U.S. and China, their geopolitical rivalry, geostrategic rivalry is so defining, how do you keep 166 members marching to the same beat? And that's a common ground that WTO members and that the Director General are looking for this week here in Abu Dhabi.
Yeah, interesting. Well, look, Eric, you follow all of this really, really closely, kind of at a granular level. You're at the event covering it for us. What are the big risks? You nodded to it. Is the big risk the rift ultimately between China and the US, or is it something else when it comes to the shape of global trade going forward?
Well, certainly the U.S.-China rivalry is front of mind for policymakers in the trade space, but also some issues that hadn't been on the radar. Just even 6 months ago, when you look at the WTO forecast was actually made 2 days prior to the Hamas attack in Israel, and so given all of the tensions that have escalated from that, talking about the Houthis and the Red Sea and Yemen and all of these conflicts that hadn't been present in people's minds, that have come as a big shock to the global trading system. And so trying to navigate all of those challenges as well. They were already dealing with the war in Ukraine and the impact on, for instance, grain shipping around the world and on food supply. And so adding now to that the conflict in Israel and the tension in the Middle East really makes a complicated backdrop for policymakers. Some of the issues that are being dealt with here are things that have been looked at before. We have an e-commerce moratorium that prohibits tariffs on digital transfers, things like movies that somebody might download or music, books. And so that's something that they're looking to renew. A lot of people are looking at that as a potential sign of whether this organization can still function, whether they can roll over again, something that's been renewed every couple of years since the late 1990s.
Okay, we certainly watch for that development, absolutely. Eric Martin on the ground for us in Abu Dhabi at those WTO meetings. We appreciate it. Now, coming up, scientists are puzzled by a spike in fatal heart disease since the COVID-19 pandemic. We discuss with our global health correspondent the details. That is next. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
4 years after the start of the pandemic, a disturbing pattern is emerging. Not only did COVID result in the most deaths in a century, but it also triggered deadly waves of heart disease and stroke. Scientists are trying to figure out why. Let's bring in our global health correspondent, Michelle Cortez. She's just finished a special Q&A on the top live function of the terminal, taking a range of questions on COVID and heart problems. The reporting that Michelle and her team have done is really important on this. Thanks for joining us then on the details. What do we know? We know, of course, that millions were killed by COVID, but now this new research that you've been reporting on suggesting that heart disease deaths also jumped during the pandemic. What do we know? What are the details?
Right. Well, you have to remember that heart disease has been the leading cause of death for decades at this point. But we were doing really well before COVID came along. Those numbers were declining, and in fact, cancer rates were rising. Then COVID hit, and the numbers were, astronomical, how many people died. And so you would have thought that you'd switched out one for the other, right? That COVID deaths were replacing some of these heart disease deaths, especially because the people who were dying from COVID were older and in many cases sick. But that's not what actually was found. In fact, in the US, for example, just over the first 3 years of the pandemic, there were 250,000 additional deaths in adults aged 35 and older. So we saw not only the COVID deaths that didn't exist prior to 2020, we also saw a surge in these heart disease deaths. So we weren't trading off one for the other, and that's something that we're continuing to see going forward.
Was it just heart disease rates that were worsened by COVID, or were there other ailments that were pressured by this pandemic and this disease?
COVID was terrible for every part of your body. We saw increases in diabetes. We saw increases in stroke. We saw increases in atrial fibrillation, and even things you wouldn't normally tie to something like an infectious disease. We were seeing more Alzheimer's disease, for example, and even cancer. So absolutely, COVID was bad all around every part of our bodies.
Why is that? And what does it mean? And if you were inoculated, if you had the vaccine, were you better protected from some of those factors? What was behind the reason for the uptick in all of those different ailments?
Right, such a great question, and that's exactly what scientists are trying to get to the bottom of now, right? Because, of course, it wasn't just that people were getting infected and that infection was killing them. That infection was also doing other things to our healthcare system, for example. So people weren't doing things like going to the doctor. They were not getting the cancer screening that they normally would have. And in some cases, healthcare systems were overwhelmed. So they stopped doing things like just any kind of preventative elective surgeries and other types of, emergency rooms were closed. Everything was overwhelmed. So there was definitely some fallout from that. But also your other question is also a very hot topic, and that we saw a lot of questions today on our T-Live. People want to know how bad were the vaccines? To what extent was that contributing? And the research is really unequivocal on this. There's no doubt that vaccines did cause some harm, but it was far outweighed by the numbers of lives that were saved from the vaccinations. That's the takeaway message, of course, that doctors, scientists, researchers want everyone to know. Of course, it is troubling if you're the one on the other end had some kind of a bad side effect from a COVID vaccine. Just like with any vaccine, sometimes that does happen. But again, those benefits, including saving lives, really did offset the risks.
Okay, really, really important reporting, really fascinating deep dive into the implications, the continued implications, of course, and fallout of that pandemic. Bloomberg's global health correspondent, Michelle Cortez, thank you very much indeed. Now to some other stories making news this Tuesday. US regulators have faulted Boeing for ineffective procedures and a breakdown in communications between senior management and other staff members. An FAA panel also found what it calls a lack of awareness of Boeing's safety-related metrics among employees. The report comes after a mid-air fuselage blowout in January refocused the spotlight on Boeing's safety issues. Let's check in on one asset that is very much on the move in the session today, and that is Bitcoin. It briefly topped $57,000 per coin for the first time since towards the end of 2021. This chart shows the volume pickup yesterday. as money flowed into those ETFs, those Bitcoin-linked ETFs, and volume surging the most yesterday since the approval of those ETFs by regulators in the US the early part of this year. So the appetite seems to still be there. And of course, you also have the halving of Bitcoin coming up. That's essentially when you take out Bitcoins out of the system to ensure you remain capped at 21 million. You've also seen MicroStrategy, that company, that software company, buying up more Bitcoins as well. All those factors seem to come in to support Bitcoin. The pricing currently at 56,600. Up next, Bloomberg Brief with Danny Berger and Manus Cranny in New York. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Japan's two-year climbs on bets that the BOJ will lift rates. Meanwhile, Kansas City Fed President urges patience on the cuts.
Shein could consider listing in London if the Chinese fast fashion retailer doesn't get approval for a U.S. IPO.
And President Biden says a ceasefire between Israel and Hamas could start as soon as Monday. We've yet to work out the reverberations of inflation in Japan, but it feels as if the Band-Aid is about to be ripped off. Let me take you through the flow. The bond markets in the US are quite quiet. We had record 5-year issuance yesterday. The bid to cover ratio was 1 standard deviation less than the average over the past year. We dig deep for you on Bloomberg Brief, but you are looking at 426 on yields. Is the basis trade fading? Deutsche Bank say some of the data in the marketplace suggests that the basis trades are fading. The net shorts have dropped by over 1 million, from 6 to 6.7 million short contracts on treasuries. It was about 7.2 million in January, but that corporate bond train keeps on rocking out. $172 billion worth of corporate bond issuance, and no sign of indigestion. There it is. It should be more resplendent. The inflation data comes in, excluding fresh food, at 2%. Again, at the money for Japan. This is 2-year yields at the bottom of your screen, the highest since 2011. Inflation is above trend. Is this the torch paper the Bank of Japan needs to raise rates and exit negative rates? It'll be the 22nd month above target. It's not having a global reverberation. Maybe I'm overexcited. Bitcoin, I can get excited about that. 57,000 for the first time since late 2021. Why? We're up 32% on the year because $6 billion went into ETFs. And of course, MicroStrategy bought 3,000 of Bitcoin yesterday. All hail MicroStrategy. They believe in the trade. Good morning.
Good morning. All hail risk. Even if Bitcoin had a good day, stocks didn't. I mean, it was quiet, to be fair. Quiet compared to what we saw last week. It was higher yields that seemed to finally crack the equity trade. We traded slightly lower, but futures are back up. S&P 1/10, NASDAQ 2/10. NASDAQ underperformed yesterday thanks to a sell-off in Alphabet shares. There was some concern, as there continues to be, around Google's AI offering. Here's my fun fact for you. The S&P has risen out of the past 16 of 17 weeks. That's the best streak since 1989. Meanwhile, CSI 300, 1.2% higher. The national team, according to UBS, has spent $57 billion so far this year to prop up the market. So more support means higher stock market here in China. But man, as a funny thing happened on the way to these all-time highs. That appetite for risk, which again is so interesting considering we're rethinking rate cuts, the appetite for risk, be it equities, be it Bitcoin, be it for credit. If you look at Bank of America's Global Financial Stress Indicator, we are now at a 4-year low. This really exemplifies the rush into risk at this moment.
And of course, that has got repercussions, Danny, that rush into risk. That's why we're talking about Bitcoin this morning. And by the way, that day that you gave, 1989, that was a vintage year, because that's the year that I graduated, knew an awful lot more about business, or running a business, never actually implemented any of it, but there are implications.
I won't tell you what I was doing in 1989.
Okay. But there are implications, multiple implications,
yes,
of this risk. You can see there's a euphoria in the market, but that's got a consequence in the FX market as well.
It does, because all of a sudden, if you want to go to high-yielding assets, why not use the yen as the carry trade?
There's a drum roll for our next guest, Derek Halpenny. He joins Danny and I now. He is the head of global markets for EMEA at MUFG. Derek, good morning to you. Inflation above target for 22 months. Good morning. Is this the smoking gun that the Bank of Japan needs to, the cover that it needs to exit negative rates, be done, move in March? And if they do, you actually say this rally could be short-lived. Good morning.
Good morning, Manus. Yeah, you know, I think this obviously helps. I think certainly the communications from the BOJ of late, in particular Governor Ueda in the Diet, he's spoken in the last couple of weeks, and what I've noticed is that his tone and his comments in relation to wages are changing. He's becoming more confident of this kind of wage price spiral, and that becoming sustained. And that really is the final piece of the jigsaw. Obviously, today's inflation falling less than expected only reinforces the potential for the BOJ to make that move. And I do think, you know, given this sense of change in rhetoric that I'm feeling, March is certainly on the cards, for sure, in particular given the broader risk, and that window for doing this hike is certainly open.
Derek, what is then the risk if they do hike in March, that they, as you write, is a one and done? It means that a yen rally can't sustain itself.
Well, I think, you know, communication is massively important, whether it's March or April when they hike. We think in April, but I think the risks are rising at March. And if there's any sense in the markets of a one and done, the danger is that the markets could then look very quickly beyond that, say that risk event is behind us, look at the carry, it's still fantastic, and then straight back in on a stronger yen, which would probably be the initial reaction. Now, I'm not saying that's going to happen. I think it's really important, and I think it's probably more likely than not that Ueda will come out and say, look, this is significant. We think we're in a changing environment economically in Japan. And I think the signals from the BOJ will be that this is a first step. Now, they won't be explicit in terms of what comes after, but as long as they avoid the oppression of one and done, then I think the yen can sustain rallies. But there is a risk that the communication could disappoint and result in renewed yen selling for sure.
I mean, it's almost as if we're venerating at the altar of Japanese assets. Warren Buffett, certainly long last year, he got the trade way ahead of everybody publicly. He's loading up again on these trades in Japan. He takes a whole page in a 16-page letter. Are we at some kind of evolutionary moment on Japanese assets overall, Derek?
Yeah, like certainly, we can look globally and say, other examples of bubbles and speculative excess. Of course, you could probably say yes, for sure. But I think if you look at Japan, while there's an element of that perhaps, I think certainly there's more fundamental justification for what's happening in Japan. And this really goes back all the way to December 2012 when Shinzo Abe became prime minister and he adopted numerous reforms. And part of the measures was to try and create greater use for the excess savings in Japan, both households and corporates. And corporates ultimately were forced into greater efficiency with its capital through increasing its ROE and its price to book values. And there was the TSE focusing in on companies that had a price to book below 1. And really, companies are responding. And we've had 2 record years of share buybacks in Japan.
Yeah.
And this is new. This is really new. And I think that's why it's drawing in investment.
Yeah, I mean, that corporate governance. But Derek, if you say there's fundamental justification to what's happening in Japan, is that you also saying on the flip side there's not fundamental justification to what's happening in the U.S.?
Well, certainly if you just look at basic valuation metrics, you would be arguing that you're concerned. Obviously, the whole AI phenomenon is with us, and there's probably more to run on that. But, you have to get nervous with the narrowness of the rally, of course, as we've all cited. Now, the broader market has done, better than last year over the last 3 months, but there's still a narrowness there in terms of the big stocks in the US. And if there is an abrupt turn in the cycle, nobody's expecting that at the moment. It is quite a cyclical sector in terms of tech. And that could certainly kind of reverse some of this sentiment at any kind of moment, and that would have obviously a much bigger impact in terms of a reversal in broader equity markets.
What would that do to the dollar? And I ask you that because one of the lead FX stories this morning is about, strange enough, US exceptionalism, whether it's productivity, rates remaining higher for longer, that delivers high yields, resilient economy, and a strong dollar. And there is this resilience in the dollar. So it's twofold. One, do you think that endures? And secondly, does that cap any rally in the yen? Ultimately, the strength of the dollar perhaps puts a cap on a yen rally.
Yeah, I read the article, and I agree with some of it. I don't agree with all of it. If the US is so exceptional, why do we have this appalling outlook in terms of debt that was published by the Congressional Budget Office recently? The debt profile in the US is horrendous, and a lot of the exceptionalism that we've had in recent years is essentially borrowing demand from abroad, from the future and bringing it forward to the present. And there has to be a price to pay for that at some point.
What is the price, Derek? What will the price of that be?
Well, I think, there are dangers going forward in terms of a loss of confidence and, disruptions in terms of liquidity in what is the most important market in the world, the US Treasury market, disappointing auctions, concerns about failed auctions, I know the Fed has set up a liquidity window to kind of diminish those risks significantly, but bringing it back to the dollar, while it doesn't necessarily result in a crisis, the idea that the dollar will continue to strengthen when you have that debt profile, I think, is very wrong. And at some point in the future, foreign investors will demand more in terms of a weaker dollar in order to finance those ever-increasing deficits.
Well, we get the next quarterly refunding announcement on May 1st. So, Derek, we're going to have to catch up after that. Maybe that's the catalyst for when the concerns come back. Derek Halpenny, thanks so much for joining us of MUFG. Okay, Manis, let's get to some of the other top stories that are trending on the terminal this morning. U.S. regulators have faulted Boeing for ineffective procedures and a breakdown in communications between senior management and other staff members. An FAA panel also found what it calls a lack of awareness of Boeing's safety-related metric among employees. The report comes after a mid-air fuselage blowout in January refocused the spotlight on Boeing's safety issues.
Charter Communications is said to be exploring a takeover of Altus USA. Charter is working with financial advisors as it studies the merits of a potential deal for the U.S. broadband and video services provider. Both firms have suffered with a surge in wireless competition.
Sean Bailey, the longtime president of film production for the Walt Disney namesake studio, is leaving the company. Disney named David Greenbaum, most recently co-head of its Searchlight Pictures unit, to the new position of president, Disney Live Action and 20th Century Studios.
Coming up, Biden on Gaza ceasefire talks. We look at the discussions for a deal with Israel to pause the war in Gaza in exchange for the release of hostages.
And as challenges with its U.S. listing continue, fast fashion company Shein may move its IPO to London. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's Bloomberg Brief. I'm Danny Berger alongside Manis Cranny in New York. Okay, let's turn to the Israel-Hamas conflict, where President Biden said negotiators were making good progress towards a temporary pause in fighting. Here's what Biden had to say about a potential ceasefire as soon as Monday.
Can you give us a sense of when you think that ceasefire will start, sir?
Well, I hope by the beginning of the weekend. I mean, the end of the weekend. At least my national security advisor tells me that we're close. We're close. It's not done yet. And my hope is by next Monday, we'll have a ceasefire.
There's something interesting talking about geopolitics, holding an ice cream cone. Okay, let's bring in Bloomberg's Rosalind Matheson for more on this. So, Roz, if Biden is talking about a Monday ceasefire being possible, how possible does it actually seem at this point?
Well, it does seem there is that big push to get towards a ceasefire in the coming days, possibly by this weekend or early next week, as Joe Biden was saying. We know that there's been further conversations going on in France involving Egypt, Qatar, Israel, the US, all about finding a way through to some kind of ceasefire agreement that Israel and Hamas can both agree on, and that's because the clock is running on this. We know that Israel has said that unless the remaining hostages, Israeli hostages, are released from Gaza, they will feel the need to go into Rafah, and that's that area near the Egyptian border of Gaza, by the start of Ramadan, and that's only about 10, 11 days away. And so either way, we are running out of time here to get a ceasefire agreed before Israel may embark on that offensive inside Rafah. Of course, the US and other nations have been very concerned about the prospect of an offensive inside Gaza because there are estimates of over 1 million Palestinian refugees bunched up in that area. The question is, where do they go? Where can they go if that offensive does begin?
And sorry, Rosalind, just to talk about another topic, which is we are looking at France and the Netherlands backing a plan to buy ammunition outside of Europe to get military aid to Ukraine quicker, and also saying everything was discussed tonight. This is Macron. So just how extensive were these discussions?
Well, obviously, Europe is grappling with the question of how to continue to support Ukraine, especially with that really big package of military aid from the US still stuck in the Congress and no sign it's going to be unlocked anytime soon. So the question is, how else can ammunition and other military equipment get to Ukraine? Because Ukraine is starting to really be on the back foot there on the ground against Russia. And so Europe's saying, well, we don't have the ability to send that much ammunition ourselves. Do we need to find it elsewhere outside Europe, buy it, and ship it in? I mean, even that's going to take some time. But the recognition that Europe can't produce enough ammunition itself to get to what Ukraine needs. So those kind of conversations. And as a result of that, again, the fundamental question of where is Europe going to be against Vladimir Putin in a couple of years, potentially, as he rebuilds his military? Does he turn his eyes further to Europe? And what does that mean for Europe going forward? And that question, if they don't stop him in Ukraine, what happens next? And so even in the ether, I mean, it's highly unlikely, but just posing that question, is there a point where Europe needs to think about sending troops itself into the ground inside Ukraine?
Well, meanwhile, Sweden also cleared that final hurdle to join NATO. They won Hungary's approval. And this is something Putin had been very clear about, and part of his disdain for what's happening in the West is this movement of NATO further eastward. So does this provoke Putin? Does it prevent him from considering attacking Baltic countries?
Well, one of the things that Vladimir Putin has used a lot in his rhetoric at home inside Russia is the idea of the West is coming for Russia, that NATO is trying to push very close to Russia and antagonizing Russia, of course, which is his excuse in a way for going into Ukraine. I mean, NATO is a defensive organization, collective defense. It's not about offensive maneuvers. But the addition of Sweden now to this, if you look at it, it's called the NATO Lake for a reason, because with Finland and Sweden, what you get is essentially no room for Russia's ships, its navy, to move through and outward through European waters, through that blue water that it needs. It puts that net around Russia militarily in doing so. And so it's a really important message to Vladimir Putin on that, is that it gives him fewer avenues to maneuver his own military, and that NATO is going to be, strong in trying to support its own members. The question is, what does Vladimir Putin, if anything, intend to do in the coming years? I mean, he did invade Ukraine. The question for Europe is, do they need to think about the prospect of a further push by Vladimir Putin? And even if it doesn't come, do they need to be better about thinking about building their own defenses?
Ros, thank you very much. Rosalind Matheson, the very latest on the geopolitical front. And just on that note, Hungary coming and agreeing to the accession of Sweden was based on, in part, an extension to their military arms and their air force capacity. So, you know, Hungary got what they wanted from this trade as well.
Yes, they certainly did. And, you know, it's a big part of the conversation of these different trades, of these different weapons, and what Ukraine wants, and what Roz was talking about of getting it from non-EU countries. I should also mention Biden. In that shot we saw, he was in New York City because he was doing a fundraiser and an interview with Seth Meyers. I got stuck behind the presidential motorcade for like 30 minutes yesterday.
At least that's a good story to say why your Uber is late and why you weren't there. Why were you out at 6 p.m. anyway in New York
You
yesterday
know,
evening?
just being a rebel on a school night. But never have I been able to say before I was late because of President Biden. So it's a good excuse.
There you go. Presidential motorcades. Nothing keeps her back. The intrepid Danny Berger. Have you got anything to say about bonds this morning? I mean, it's all a bit sort of anemic when it comes to the bond market reaction. If anything, it's the JGB market where we really want to keep an eye. But this is where we are at the moment, dipping ever so slightly. And Derek Halpenny just wrapped it up beautifully. We both made notes on it, which is, you know, this unique position for the U.S. The dollar and the bond market will only last for a certain period of time because eventually debt and debt levels matter.
Yeah, I love this. If the U.S. is so exceptional, why do they have such a huge debt pile?
Well, it can come back to bite you. There you go, 426 on bonds. Any duration hunters? Good morning from New York.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's gonna happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's been very brief. I'm Manus Cranny alongside Danny Berger in New York. She got here. She was behind the cavalcade for Joe Biden last night. She made it to work.
You know, there's also a Trump impersonator behind the motorcade too. I was like, this might be my hell.
These are our lives off camera. But what she was chasing was, of course, most credit and private equity stories.
Yeah, so EQT, Manus, announced this morning that it's just fundraised its biggest fund ever, 22 billion euros. That's $24 billion for those playing at home. Their target was 20 billion euros. They've already invested 30 to 25%. I mean, this is a really big fund. It's not the record.
No, But
it is a very large fund.
Because I did look up the record.
Yes,
Actually, to
please.
be fair, we both looked it up. And
Do
Danny
tell,
said,
Manus.
"Have you got this right?" I said, "I have." It said, "It's not CVS. It's not CVS. The chemist. It's CVC Capital Partners. Of
Yes.
course, they raised 26 billion. I just wondered to what extent. I mean, you and I were talking about this. This is about the exit game, isn't it?
It is.
It's about the price of assets, and it's about the exit game. And for CVC, they raised 26 billion last year. But this is going to pump up the value of those assets that they're all chasing in the private equity world.
Well, I'll tell you why exits are so important is because it's so hard to exit right now. You're not getting a high as a price as you want. People aren't willing to pay as much. So people aren't exiting, which means investors aren't getting their money back, which means they don't want to give new money. They don't want to commit new capital. So it is remarkable to raise a $20+ billion fund
in such a short space of time. That just shows you the divorce between asset owners and the desire to sell them. We're going to talk you through the markets in just a moment. Breaking news from Campari to come.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a three
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
According to UBS, $57 billion has been spent year to date by Chinese state funds buying up equities. So there you go. That's behind the rally.
Well, you can always depend on the state to intervene in that market, but the question is, can it actually get new flows into the market to sustain any kind of momentum? Now, you're looking at treasuries this morning, 4.26. Derek Kalpany was with us this morning talking about the Japan story, the inflation story, and what happens next from the Bank of Japan. But what he did remind us was this US exceptionalism, if it's so exceptional, it may not endure. We saw the bond market shake once in the autumn over perhaps supply and the debt load in the United States of America. And he reminds us again that that's a very, very real threat. Maybe not in the near term, but in the medium term. You've had a record 5-year bond auction yesterday in the United States of America. The bid to cover ratio was 1 standard deviation below the 1-year average. Is the basis trade, is that trade fading? Deutsche Bank said that it is, but we still have this corporate issuance coming plenty, $172 billion worth of corporate issuance. There is the rally in the yen, and it's not that magnificent, is it? You know, it's dollar down by 0.25% on this better, less good inflation coming in at 2%, excluding fresh food year on year. You're looking at 2-year yields, the highest since 2011. Again, the narrative will build that March is a live meeting for the Bank of Japan to rip off the band-aid of negative rates. Ueda has been talking about wage rates according to MUFG, and that is something which is going to push this narrative about a more aggressive Bank of Japan. Bitcoin up 3.8%, Danny. We topped out 57,000 for the first time since late 2021. We're up 32% on the year. You've also got MicroStrategy coming in and buying Bitcoin. And don't forget the ETFs. We love ETFs. The money's flowing into ETFs and Bitcoin.
I mean, it's great to hear because when, I mean, we're going to talk about ETF flows in just a little bit, but, you know, when the Bitcoin ETF first came out, there was not much excitement. So it's great to see it's come back. But I am excited about what Derek said about the BOJ, this idea. No, I do like, well, I like the US exceptionalism line, but I also like the idea that the communication risk for the BOJ is that they make it seem like it's one and done. So he says that UAID is going to need to come out and say this is a changing environment, this hike is just a first step, or else a rally in yen will be short-lived.
But even if you look at that rally in the end this morning, it's very limited,
yes.
It's very marginal. But the counterbalance to all of that is, how much can yen rally in the face of a very strong and a very exceptional dollar? So to a certain extent, the yen's rally or potential rally is capped ultimately by the higher for longer and the stronger dollar. We got there.
Maybe fears over the debt load save the yen. Maybe. Well, look, while we're talking about can the yen rally, the question also is, can these U.S. equities continue to rally after a record week? Our next guest remains cautiously optimistic, writing that the continued momentum and broadening of the rally in U.S. equities is contingent on inflation sustainably cooling and the Fed beginning its cutting cycle in line or close to market expectations. Joining us now is Kareem Chedid, Chief Investment Strategist of iShares EMEA at BlackRock. Kareem, great to see you. Great to see you in New York. You made the trip over and you woke up early. We do appreciate that. So tell me about this idea, because I thought this rally was all about AI. Is that not enough to sustain us for the rest of this year?
Yeah, early rise with the help of jet lag is all good. So I think that the AI-driven rally does have further legs to go. I mean, with the way that we nuance it is to really think about the benchmark view and then the tech sector and AI view. And at the benchmark level, we are neutral US equities. I mentioned the volatility that we're still seeing from inflation. We saw that with the hot US CPI earlier this month and the market reaction, which, we had some volatility in rates on the back of that. But AI is strong, and we are seeing with the earnings numbers that, as you said earlier, Danny, it is backed up by fundamentals. This is not like the tech of the 2000s, and so that has further room to run, and is why, on an overall basis, we are still overweight on U.S. equities.
You would say that even though the flow perhaps wasn't as aggressive in January, but you put that down to certain tax issues. Can I push you and ask you how the flow's been in February? We're nearly in for the final set of data, and if you haven't done it before you go to your internal meetings, you're going to get a surprise.
Exactly. Yes. Thank you for forcing me.
It's
to
okay. Productivity lives in Bloomberg.
Yes, exactly. And you said it yourself. You love ETFs, so ETF flows have been really interesting to monitor in February, because what we've seen is, in December it was all about U.S. equities. Now broad benchmark flows, so into the broad trackers. Now this is obviously, there's some of it that has to do with seasonals that we see every year with the bumper December and a bit of a slower January. Zoom out and look at the sector ETFs, and there you will see that Jan and Feb, we have had a bumper 2 months for tech sector ETFs at $12 billion year to date. The second largest sector in terms of flows gathered in ETFs is healthcare, and that's 1.5 billion, which is still good, but it's 1/10 of what we've seen in tech.
Shocking.
So it's a pretty big gap.
Well, I also know you write about the chunky flows into IG, that IG funds had their second highest monthly record. How do you make sense of that at a time where interest rate risk is also coming back?
Yeah, it's an interesting one, because there we see some regional nuance. So in Europe, where the interest rate risk is perhaps a little bit less of a driver, you don't have as much of a term premium driver as you look further out the curve than in the US and maybe even the UK. In Europe, we see full duration flows. So a lot of the flows that we've seen into Euro IG credit ETFs are into full duration trackers, comfort taking on the duration risk. It slowed down a little bit in February, but it's certainly still one of our strongest themes and one of our highest conviction views. In the US, obviously, you've had a lot of supply coming in US IG, high quality credit, but it's being very well digested by the market. So not surprising that we're also seeing that in the ETF space.
I think it was 172 billion. Let's find a fact. Always dangerous with a fact. Yeah, I've got a fact.
You got a few facts on that sheet.
I've got a lot of facts on here. If you want to know where it all comes from, there you go. 172 billion, a record in February. Can we circle back to Japan? Because certain parts of your house are talking about Japan's ability to trade higher. A number of houses are putting out notes this morning about breaking through the record highs in Japanese equities. I'm just curious, has the flow been consistent into Japan? What can you tell us about the flow or the momentum into Japan assets?
Yeah, I was hoping you'd circle back to Japan, because it is our largest overweight when it comes to developed equities. So in agreement with some of those other house views that you're talking about, the driver for me is one of domestic flow. So typically in the past, you would really see that when Japan rallies, and it's quite a high beta market historically when you look at the large cap indices, when Japan rallies, it rallies when foreign investors come in and buy the market. This time, the drivers are a little bit more sustained in my view, because the domestic retail investor is playing a bigger role as they are moving some of their cash savings into stocks. Why are they doing that? Because inflation is coming in. This morning's number is the 22nd consecutive number of CPI at or above target of 2%. This is creating a cultural shift for domestic investors.
Do you think that trickles down? Do you think that really is trickling down in the zeitgeist?
Yes, because it's a cultural shift of when you were in deflation, you could sit in cash. When you're in inflation, you can't afford to do that. You have to think of investing. And so that's pushing some flows into the domestic equity.
I mean, there are flows coming from one specifically, definitely not Japanese investor, and it's Warren Buffett. I mean, he's talked about how he likes the corporate governance changes that are happening in Japan. Derek Halpenny was talking to us about this too. So is there then, if this is domestic-driven flows right now, is there room for further international flows, or is that something that's a bit more fickle and not reason enough for there to be a sustained rally, that it needs to be that structural shift you're talking about?
So the way that I look at it is we have had the corporate governance reforms, which is another exciting reason that we like in terms of the Japanese equity market. Now, I need to see, is that translating to the fundamentals? And it is. Japanese equities are the market with the highest pace of earning revisions, earning upgrades in the past year. So this is across all equity markets globally. So this is something that's showing that that change in governance, the Tokyo Stock Exchange announcement is trickling through to higher ROE, higher free cash flow yield, higher earning upgrades. And that keeps me positive on the stock market.
Can we finish off with pitching BlackRock, against UBS?
Ooh, a little drama.
A little drama. We had Mark Hafley yesterday with us saying, look, he thinks international investors are suffering from home bias. The Europeans, the Japanese, the Chinese, etc., all hunkered down in domestic markets and perhaps are under the necessary exposure to the US. I know it's difficult to make that assessment from flow, but is there merit in that argument? Is that the vacuum cleaner is going to reignite itself in the US in terms of a draw?
I mean, this, as a strategist covering Europe in terms of client base, I think it's something I can comment on in terms of, anecdotal, as well as some of the analysis that we do in our portfolio consulting team, where we pull together the asset allocation of a lot of wealth portfolios. There is a home bias. There's a home bias towards
naturally,
yeah, of course, towards European equities, which has sometimes been a detractor of performance because of the underperformance of European stocks to US stocks, especially because of that tech tilt, which is a lot bigger in the US. Anecdotally, I'd say we are seeing more and more demand towards US equities. We are seeing, it is a conversation we're having around portfolio allocations and what the benchmark should be. And it fits into this idea that the way that you think about your SAA, your strategic asset allocation, in the new market regime, which is more dynamic and more volatile and more dispersed, so you have dispersion of earnings and dispersion of returns. In such an environment, you have to review your strategic asset allocation more frequently.
Okay, it's called being nimble.
Exactly.
Okay, and nobody more nimble than yourself. Great to have you with us this morning. That is our guest this morning on the markets. That is Kareem Chedid of BlackRock on the markets. Be nimble. That's called, make sure you get your portfolio strategically aligned. Good morning from New York.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg Brief. I'm Menace Cranny alongside Danny Berger in New York. Shein is considering a possible switching of its IPO to London after many challenges trying to list in the US, according to the reporting by our colleagues at Bloomberg News. Today, we have our consumer reporter, Dasha Afanasieva, joining us. So this could be a big feather in the cap for the LSE, but what is the thinking between pivoting from a US listing, where there's more depth, more liquidity, some would say, relative to London?
Good morning. I actually think that at the moment there's not that much difference in terms of disclosure requirements, in terms of governance rules, all of these things that companies debated for a long time. And the bigger difference could be litigation risk. Obviously, in the US, it's a lot easier to file lawsuits. And I think it is changing in the UK, particularly with things like greenwashing legislation. But in the US, the likelihood of getting sued is a lot greater. But it all sort of reminds me of when the UK was absolutely desperate to get Saudi Aramco listing, international listing. Obviously, that's completely different because it's a massive oil company. But you also saw how the lengths that the UK authorities were willing to go to in order to accommodate a massive listing, as you hinted at.
Well, it looks like one company is about to go public, and maybe another company is going to go private. Samsonite, which, I mean, makes every suitcase on the planet, it feels like. They have the Tumi brand, all of that. Why are they considering moving away from Hong Kong, from their Hong Kong listing?
I think the logic of IPOing in Hong Kong back in 2011, at the same time as a bunch of other companies, is that you tap into this rising middle class in China, and that for Samsonite hasn't quite happened, and there's also been the turbulence from COVID, and as a result of all of that, it's actually trading at a lower multiple in terms of PE than it was before the pandemic. So you can see the rationale in switching to either a listing in a different country where maybe you'd get a premium, or a sort of take private, where a private equity firm, for example, holds the company for a while and then sells it to a larger fashion conglomerate. I should also add that if you compare, say, other listings, the UK versus the US we were talking about before, the other thing is direct to pay, which can actually be much greater in the US, where there's less scrutiny too. So just to add that on.
So Dasha, we're just about to get into the meat and potatoes of retail earnings. Macy's will report before the bell. What is the latest on their archives bid? That's going to be the key, isn't it?
Absolutely. Arkhouse has has nominated 9 directors to join the board. So you can see how this campaign to take over the company for $5.8 billion is gearing up and becoming more aggressive. And I guess for Macy's, the challenge for the management, which has disappointed investors in the past in how it was running the company, is to demonstrate that in the long term, a better value proposition is actually the company holding on to its real estate and not weakening itself by essentially selling off the real estate, therefore weakening the brand. And some analysts are saying that it would raise the likelihood of its eventual demise.
Dasha, thanks so much. We're going to get Macy's and Lowe's today, so a lot to look out for. Dasha's Afanasieva, thanks so much. Now, Alan Waxman, the CEO of Sixth Street Partners, says his firm is ready to capitalize as banks grapple with the stress in their real estate portfolios. Waxman spoke with Bloomberg Sonali Basak as part of our Bloomberg Invest series.
Look, anything that is a levered asset class that has floating rate liabilities is at risk, and that applies across big parts of the economy. Again, is it going to break? It may not necessarily break because it depends on how high rates get increased. And again, that's not our predominant probability, but it will create additional stresses in the system. And that's something we're always watching out for.
As things start to weaken in some parts of the market, you think about the regional banking system and how much private credit players have been able to step into that fray. What is the opportunity for you now to buy assets at prices that may have started to fall off in value?
The way we look at the opportunities, not only buying assets, but really what we're trying to be is provide new capital or new equity or more just general capital into situations, whether it's companies or real estate assets. So that's kind of the way that we think about it. I think we're far off from banks, fire selling assets. That's not our predominant probability because, again, the economy is pretty strong right now and arguably maybe getting too strong. So that's not our predominant probability. But obviously, when you look at what's going on in commercial real estate, again, we don't think this is systemic risk, but there are obviously large exposures, particularly in some of the smaller and regional-sized banks, and that's something we're looking out for.
How much pain is there in that system?
It's meaningful. When you look at the tangible equity in a lot of these regional banks, and then you sort of transpose it against the unrealized losses, it will create stresses. Obviously, it's bank by bank dependent, but again, the economy is really strong right now. So I think that's providing some protection for that. But if rates stay higher, that will obviously create additional stresses.
Well, you mentioned the commercial real estate market and the real estate market more broadly. If you were to put money to work in that sector at scale, what could that look like for you?
It's interesting you say that because the last few years, so we have a big real estate team. The last few years, we haven't really done that much because we thought valuations got way too speculative. And what's interesting right now, it's in fact one of the things that we think is one of the bigger opportunities for Sixth Street is because we're sitting with a pretty clean portfolio. There's lots of opportunities, and that's really across the whole commercial real estate spectrum, not only in the U.S., but also in Europe.
Are there parts that you avoid? You think about just how damaged the office sector has become and worries about work from home and the impact that they may have on big cities. Are there parts of the area that you avoid?
In general, there's obviously different markets that pose different risks, but as long as something's not binary risk, we can generally price it. That's what we do. That's our job.
That was Alan Waxman, CEO of Sixth Street Partners, speaking to Shonali Bassik. Ken, you can catch Bloomberg Invest Conference in June, bringing together some of the top names in finance, economics, investing for the year ahead. The strategies, the opportunities in terms of looking at markets. Coming up, we'll give you what you need to know in the very near term. It's how to survive the rest of the day.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg, context changes everything.
It's Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. Before the opening bell, we're going to get some retail earnings from both Macy's and Lowe's. Then more eco data. Durable goods hit at 8:30 a.m. Eastern. U.S. consumer confidence, that comes at 10 a.m. Then the primary for both Republicans and Democrats starts today in Michigan. So, you know, political risk maybe kind of sort of there, but certainly definitely the economic data, Manis.
A couple of stocks to keep an eye on. Of course, it was a tragic day for Palo Alto just a few days ago. We've got a nice rebound there from their earnings fueled drop. Then you've got Zoom up 12.4%. Earnings forecast also said the board has approved a buyback program, so the stock is roaring ahead. Coinbase, I showed you Bitcoin a little bit earlier. We traded up to 57,000, so all roads lead to a nice bid there. Danny.
Also, a nice bid for Japanese bonds, a little bit when it comes, or opposite, sorry, selling Japanese bonds this morning. A little bit of a bid for the yen. You got to feel for the yen. We get inflation above forecast. We're still above 150.
It's a pretty miserable rally in the end, isn't it? Derek Halpenny was with us from MUFG. Go back on TV Go, have a listen to that, because the risk is that the Bank of Japan indicates it's one and done, and that stymies your rally in the end, but nothing stymies Bloomberg Brief.
It certainly doesn't, except maybe the next show coming up, which is surveillance. So that's it for us. Stay tuned. It's Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
It's very much a sort of late 90s type market.
Macroeconomic data is not being considered as seriously as the likes of NVIDIA results, which to me is bonkers.
At least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks.
The longer the Fed keeps rates higher, the higher the odds that we see a meaningful slowdown in growth.
The Fed is in no rush to remove the policy firming that they've put in place over the past 2 years.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrell. Your equity market little changed on the S&P 500. Big morning, big couple of days for the US retailers. Kicking things off this hour with Macy's and Lowe's. Then on to tomorrow, TGX, and after that, Best Buy. Lowe's, Bramo, crossing the Bloomberg right now.
Yeah, what we're seeing is a host of earnings, and we'll parse through those numbers. But what people are looking at right now is the potential for some indication of whether the blip that we got in January was just a blip or something greater. What they do see is actually below estimates, seeing full year total sales of $84 billion to $85 billion versus an estimate of $85.6 billion.
Macy's up next. We'll get to those numbers in just a moment. Speaking of the retailers, let's talk about the supermarket chains and the trouble between Kroger and Albertsons facing a challenge. Very, very predictable challenge down in Washington, D.C. Washington says it will hurt the consumer. This is what the company's got to say for themselves this morning. If the FTC is successful in blocking this merger, it would be hurting consumers and helping strengthen larger multi-channel retailers such as, drumroll, Walmart, Amazon, Costco.
The very companies that the FTC is actually saying that they want to try to rein in. But Jonathan, as you say, this is just no surprise. Add Kroger and Albertsons to a list of companies and potential tie-ups that this FTC has gone after. What we've seen is a more robust engagement from this FTC and DOJ when it comes to cracking down on antitrust. So this is going to go on for a few months. And Bloomberg Intelligence says it's basically a coin toss, 50% whether or not this goes through or not.
If we can't make this happen, if we can't make JetBlue Spirit happen, how on earth are we going to make Capital One Discover happen anytime soon?
Everyone's watching to see whether this is actually going to be allowed, because if two grocery stores that might otherwise go out of business, one of them, or struggle certainly versus the Walmarts, the Amazons, can't get together, and if they're citing certain things like being able to negotiate better with labor unions and things of that nature, we're talking about a game changer for the M&A space. And you're already seeing a lot of commentary saying how many companies, how many Berkshire Hathaways are not interested in making any kind of acquisitions because, frankly, what's going to get through?
It can't get it done. In the equity market, we talk about bigger being better. In Washington, they just talk about big being bad. And that's it, bottom line. I think we often talk about Senator Warren. Senator Warren's got company, not just within her own party, but maybe even across the aisle. And I think that's pretty interesting.
Yeah, it is. She has across the aisle with like Senator Josh Hawley. Also yesterday, what we saw is a release of this letter, 13 lawmakers joining Senator Elizabeth Warren about Capital One Discover. And then also, Senator Elizabeth Warren sent a letter to Secretary of the Defense, Lloyd Austin, about concerns about any M&A, which I haven't seen any as of late, but any M&A in the defense industrial complex, which makes me think across the scope of sectors, she does not want to see a merger. And she's getting ahead of it.
So this was the rant over the weekend. Just giving it to you. In brief, don't worry, it's going to be a short. But here's the question. How many of the big companies that are dominating now are benefiting from all of the M&A that they did before? And how many companies are smaller and struggling now that cannot get in the game because a lot of this M&A is prevented?
Well, you ranted about Mark Zuckerberg and Meta again over the weekend. Is that what that was about?
It was really, you have to call me out.
I'm just trying to work out who the rant was aimed at.
Yeah, sure, there's the Instagram issue, but there's also all of the small acquisitions that just build up tick by tick. What's kosher and what's not? I mean, how do you define that?
Still trying to work it out down in Washington. Bottom line, big, bad. That's it. There seems to be no nuance in between. Equity futures right now on the S&P 500, just about positive by almost 0.1% on the S&P. Yields going almost down a basis point to 426.97. There is some price action in foreign exchange away from the euro. I'll be talking about dollar yen in about 25 minutes, so look out for that. Through the next hour, we'll be catching up with Katrina Dudley of Franklin Mutual Series with the US equity rally stalling ahead of key data this week. Terry Haynes of Pangea Policy as President Biden invites congressional leadership to the White House to try and avoid a government shutdown. And the brilliant Hugh Van Steenis of Oliver Wyman as we approach 1 year since the collapse of SVB. We begin with our top story this hour, the US equity rally hitting pause ahead of a busy week of Fed speak and data. Katrina Dudley of Franklin Mutual Series saying it's time to diversify. Quote, the percentage of the market represented by tech stocks is close to 30%, but only represents 20% of the earnings. We aren't bearish tech per se, but we do think it's time to diversify where there are cheaper valuations with good growth prospects. I'm pleased to say that with us in New York around the table, Katrina joins us now. Good morning, Katrina.
Great, good morning. Thanks.
Let's get into this. My number one question this morning, what on earth do you do if you've missed this rally? Not just last year, but again so far this year as well.
Look, I think that it's not that we're advocating that you suddenly divest the Magnificent Seven. I can see this being, we look at NVIDIA and we look at the fact that they beat revenue expectations and earnings expectations. But what we're saying is, why don't you go shopping in like the 490 other stocks that exist in this market? And I think, though, the interesting thing is with the Magnificent Seven, it really hasn't been, you haven't been paid to be a stock picker. You kind of bought that basket of 10 and you were fine. With the 490, you've got to pick your stocks and you've got to pick your points and you've actually got to start doing research. And I've been a research analyst my entire career, and that's what we like doing.
Well, this is really the key for a lot of people. They're saying time to do research, time to go into maybe less loved sectors like consumer cyclicals. But I'm looking at Lowe's earnings right now, coming in disappointing. I'm looking at the retail data from January, very disappointing. Does that give you pause to go into some of these cyclicals?
Yeah, I think where we're seeing pause is in some of these lower-end consumers. So you look at something like a McDonald's that came out and said that they're seeing that pressure. And so what we need to see is we need to see a little bit of the wage increase. We're seeing a small amount of wage increases, but we actually need to solidify and shore up that low-end consumer. And once we shore them up, I don't think we're going to see this weakness. And I think that we can have less of this dichotomy between the macro story and the micro murkiness.
The good news, good news, good news, bad news, bad news, good news. The reason why I'm going here is because yesterday we saw yields in the 2-year go up to the highest levels since November of last year, certainly since the previous Fed meeting, and yet small caps outperformed. Do people not care anymore?
Look, why are small caps outperforming? Number one, valuations are cheaper. So you can kind of, you get access to great end markets at much more discounted valuations. Number two, we are onshoring, and that's really accelerating. And you look at what's happening in China, you look at what's happening in, in Shein and everything in terms of we're really concerned about that. So going for your domestically focused small caps makes sense from that perspective as well. Finally, you've got some of these small caps that are actually saying, you know what, we really don't want to keep raising debt. You're going to start to see them raise equity potentially, and really they're going to solidify those balance sheets. And we were just talking M&A, but they're the companies that can do M&A because they're small enough.
It's true.
You just look. I mean, we were talking. We've got things like a McGrath, which is being bought by Will Scott. You have no idea what they do, but they rent mobile office space and classrooms. And the FTC doesn't seem to be worried about those type of companies because they're smaller and they're not going to generate the headlines.
I love that. That's the cheap guide to getting a deal done in Washington. Have you ever heard of the company?
Nope.
Done. Can we talk about how insulated this equity market is to rates? That's what Lisa was getting at here, and I do find it interesting. How insulated are we, and why are we so insulated to weekly moves in rates in a way that maybe we weren't 3-4 months ago?
I want to say it's the telegraphing that's been the big difference this time around. I mean, you look at what the Fed is just continuing to tell us, data dependency, and we are watching that data. We look at this kind of triangle, as we've talked about it, between inflation and growth rates and interest rates, and they're the three prongs of that triangle. In terms of inflation, that's coming under control, but we do think it'll be slower to normalize at the rate that the Fed needs. If we look at growth, it's continued to be strong, and the final, kind of the third leg of that stool is interest rates, which the Fed have said we're just waiting. We're going to be patient. And if you listen, that's exactly what they've been doing.
We've pushed out the timing. The Fed's done that. It's been reinforced by the data. We've reduced the magnitude of cuts this year as well, and yet still this equity market is rallying. And some of the bulls out there are hopeful, super constructive that we've had this handover from a Fed-driven market to an earnings-driven market. Would you endorse that as well? Do you think we have had that handoff?
Yes, if I have a look at any type of rate cuts, we're looking about a rate cut as being more supportive and really just supporting the economy instead of a rate cut being in response to very bad data coming out. And I think that that's a very different narrative, and that's really what the narrative has shifted to. If we go back 18 months even, we were talking about recession fears, and so we were talking about rate cuts as kind of being the offset to recession. Now we're talking about rate cuts in kind of a more like, well, they just can take their pedal off the accelerator.
Which is the reason why it's sort of this virtuous cycle. It's sort of the Fed will give if things are good, and the Fed will give if things are bad, maybe even a little bit more. Some people are saying because of valuations, the U.S. looking less good and the rest of the world looking more attractive. Do you buy into this, or do you think that the U.S. is going to retain the bastion of growth in an otherwise real slow-growing world?
So let's think about why the U.S. is this growth engine. I mean, I always talk about the fact in the United States, it's okay to fail. I mean, it is actually a badge of honor to have launched 3 startups that did not work. And so we have this culture of innovation. And that is what has driven us to create so many large cap dominant tech peers. Yes, they were supported by a little bit of M&A, but by and large, they've built these companies. You just don't have that outside of the United States. You do have some good franchises, but there are areas that we're a little bit worried. If we take a look at something like a Novo Nordisk and the percentage of the Danish stock market that it represents in just one stock, it's much more risky than, for example, the Magnificent Seven and the percentage of the stock market they represent here.
But the risk to that concentration in the United States is still quite large. I'm looking at the geopolitical risk for all these companies. 90% of them, in terms of their chips, are tied to Taiwan. Are you concerned about these kind of risks?
I think what we're seeing is that they're really addressing those already. I mean, unfortunately, it just takes time, but time will cure that problem as they reshore that manufacturing here. And that's one of the good things. If you take a look at, a problem, if time can cure your problem, you've just got to wait it out. So I think that that's what we're seeing in those markets.
Katrina, good to see you. Thanks for dropping by. Katrina Dundee there at Franklin Templeton. Way too much bullishness. So this is from Marko Klanovic of JP Morgan, just to set things a little bit more balanced this morning, Bramo. You'll appreciate it. Inflation risks are skewed to the upside given loose financial conditions, tight labour markets, easy fiscal policy, which could keep the Fed higher for longer. We believe. Here's the punchline. Heard this from Marco last week as well. There is a risk of the narrative turning back from Goldilocks towards something like 1970s stagflation.
Well, and he's not alone. And if you look at the margins, no one's willing to say 1970s, but they say it in other sort of softer ways. Housing might be reaccelerating, housing prices ticking up. We're a little concerned about the bottoming out of this commodity cycle, things ticking up. I mean, you hear about it on the margins, but no one's willing to get that bold because it basically exposes you to all sorts of criticism.
What like? Are you saying you've received some of that criticism yourself?
No, no one has ever accused me of being overly pessimistic and skeptical of the world.
Equities right now, just about positive by 0.1% on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. Federal Trade Commission has sued to block Kroger's $24.6 billion takeover of Albertson. The regulator joins 8 states and Washington, D.C. in opposing the deal. They're arguing it would eliminate competition and lead to lower wages and higher food prices. The merger would be the biggest U.S. grocery deal in history. Together, Kroger's and Albertson would have nearly 5,000 stores across the country. Expedia is cutting about 9% of its workforce as online travel company attempts to revive growth and regain market share. The Seattle-based firm will cut about 1,500 jobs across the globe, with some affected employees notified on Monday. Earlier this month, Expedia reported disappointing holiday results and issued a weaker-than-expected outlook for the current quarter. It also announced a leadership shakeup. Alphabet shares fell almost 4.5% on Monday on renewed fears the Google owner's missteps in AI are putting its search business at risk. The company paused Google's image generation feature last week after criticisms over inaccurate historical depictions of race. Analysts have warned the problems may fuel a perception that Google is an unreliable source for AI and may create an opening for competitors. That's your Bloomberg Brief, John.
Danny, thank you. So much to say on this a little bit later in the program. Are they putting ideology before facts at Google? It's a big question. Up next on this program, another government shutdown deadline fast approaching.
The deadline to avoid a partial lapse in government funding is fast approaching.
Even a partial shutdown would mean chaos and pain for the American people.
That conversation coming up next, live from New York City. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, equity futures on the S&P 500 bouncing back just a touch, up by 0.1% on the S&P. After 3 days of gains, we snapped that yesterday in the equity market. Yields a little bit lower by a single basis point, 426.58. Under surveillance this morning, another government shutdown deadline fast approaching.
The deadline to avoid a partial lapse in government funding is fast approaching. Without action by Friday, the country would face needless disruptions.
We want to avoid a government shutdown. We want to work with all our House counterparts to spare the American people of the pain that a shutdown would bring. Even a partial shutdown would mean chaos and pain for the American people.
Here's the latest this morning. President Biden meeting with 4 congressional leaders at 11:30 today to try and make a deal to avoid a looming government shutdown on Friday. The next deadline is a week later, March 8th, when a full shutdown would take place. Terry Haynes of Pangea Policy writing this: the White House meeting will show that Washington doesn't want to be fiscally responsible and is paying no attention to increased market concern and dismay about the United States' fiscally unsustainable path. Terry joins us now for more. Terry, what are the odds that we avoid a shutdown and this speaker keeps his job?
I think the odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that they kick the can for a week or two with some more temporary spending to try to work out problems. There's also the optics, even for the Republican purists who are charging a lot of this. The optics of having a government shutdown either right before or right after the State of the Union address. Now, I have no doubt that some of them might like that, but the optics are terrible for Republicans who are thought by the public to have a better economic handle than the Biden Democrats. So I think this probably passes. But the bigger question is, this is going to bumble on for a month or more with the idea that by April 30th, there are mandatory 1% cuts if they can't come to a deal. So those same Republicans think their leverage grows.
Well, that's what I wanted to ask you about. How much do we just end up at April 30th and then we get this 1% cut across the board? And I guess for the Republicans, they don't get some of the policy riders they want in terms of these provisions, but they do get the cuts. Would that be a win for them?
Some of them would see it that way. Yeah, I think so. And, but also what I would say principally for markets who would be concerned about downturns in defense spending, for example, is that you'll have a 1% cut, of course, but then what you'll end up with are some kind of exemptions or workarounds so that defense spending doesn't go down. I mean, that's just my primary example here. What you're going to get is kind of a muddle for the next 6 to 7 weeks and a hodgepodge of results.
What do you think we get out of this meeting today? Biden having the top 4 legislative leaders over today at the White House, but the shutdown is midnight on Friday. Is it a little bit too late?
Well, I think it's like most things in politics and many things in markets and in life. It's a lot of it's posturing. Biden finally wants to be seen as doing something as a preview to the State of the Union. I think you get mixed results, frankly, for markets. You get kind of a plus on the foreign aid and U.S. global leadership box because you're going to see, with the exception of House Speaker Johnson, you're going to see the vast majority of Congress focused and pushing on getting aid for Ukraine, Israel, and the Indo-Pacific. I think the little bit of negatives are the shutdown, frankly, for markets for the fiscal reasons that I mentioned.
Although markets don't seem to care. Is this something that markets are going to wake up to, or is this basically something that no one asks you about, but they kind of have to keep an ear out just because check off the boxes?
Yeah, like 15, 20 years of this. I mean, inside the Beltway, it's, kind of the usual towel snapping, who said what to who kind of stuff. But, markets really don't care about this. Markets will start to care if it starts to affect, let's say, the defense supply chain, kind of real-time issues. But, the markets are in on the joke and have been for some time. They know that what will end up happening is just Washington will end up backfilling whatever hole they create.
There might be more of a response to this aspect. President Biden saying yesterday that it seems like there's some sort of agreement to pause fighting in Gaza for the near point. He was saying, my national security advisor tells me that we're close. We're not done yet. My hope is by next Monday. Would that have a material effect? Does that mean something to you in concrete terms?
What it means to me is that the president wants to continue to look relevant in those negotiations and in the Middle East generally in the run-up to the Michigan primary more than anything else. I mean, it's not lost on anybody down here that the reason why he says this the day before the primary is he's trying to head off a problem with getting large numbers of uncommitted votes, and they are called uncommitted votes, in that primary that might make him look weak or cast aspersions on the administration's Middle East policy.
Terry, what is the bar for the president in that primary? What does success or failure look like?
Well, I mean, obviously, John, he's going to win, but I would say if you get uncommitted votes in double digits, by which I mean double digits, 10% or more, it's going to look like the White House has not been is weak in terms of its core voters, first of all, and secondly, that it's not messaging. And normally I kind of give the back of my hand to messaging concerns as secondary. But in this case, what the White House really needs to do is forthrightly tell the public and tell them repeatedly what we're for, why we're for it, and what we're doing about it. This president could do with a little less box ticking for all the coalitions, a little bit more standing firm and telling people why we're doing what we're doing.
Given today is just a primary, these uncommitted votes, which this group is trying to get to 10,000 to show that margin of Trump and Clinton 2016, when you look out to November, potentially they come out and vote for Biden. How many can he lose in this Arab American community and still get it across the finish line in Michigan?
Oh, I think probably quite a lot. I mean, there's no serious opposition in the primary, number one. Number two, Michigan is always considered a swing state, and you all have done some very good reporting on the idea that Trump voters tend to come from traditional Democrat middle-class union households. At the same time, I think that, firstly, there will be a big Biden get-out-the-vote effort. Secondly, my my call on Trump continues to be that he's weak because he's not consolidating the party, he's not getting the party behind him, and he's losing a lot of independent voters. So, you know, I think they could stand to lose a fair number of Arab American voters in the final analysis and still come and still pull through.
Terry, what you just said, the weakness, the perceived weakness of the former president going to the national level, was that reinforced by the results from South Carolina over the weekend?
Yeah, I think absolutely. I think what you end up seeing is kind of a party split, you know, somewhere in the 50-50 to 60-40 line. Even in a strongly Trump place like South Carolina, he couldn't get to 60%. You know, he was barely under it, but I mean, he couldn't get to 60%. And I think that carries through both in terms of Republican voters, Republican kind of grandees, I mean, including people that have served in his first administration, are going to be strongly against him and will say so repeatedly and motivated to. And then you have the problem with the independents. And he knows he's weak. I mean, one of the many reasons you can see that is how quickly he came out on IVF. Right? I mean, he's, you know, seeking to separate himself from the party on that and trying to make up ground with independents who probably have already made up their minds against him anyway.
True. Such a good point. Terry, good to catch up. Terry Haynes there of Pangea Policy. On the surface, it looks absolutely dominant. Anne-Marie, we're talking about double-digit wins, Iowa, New Hampshire, South Carolina. You get into the nuances of it. Terry's view, it's not that dominant.
Well, Terry shares the view of a lot of individuals who are looking at the voters coming out of these primaries. And when you look at Republicans who lean a little bit more independent, or if it's an open primary and they didn't vote in the Democratic vote and they are independents, they want an alternative. And Trump is just at 60% in South Carolina. That's closer to 50% than 100%. What it shows is that he has the base, and he has a lot of work to do to general. I think what President Biden is going to show potentially today with these uncommitted protest vote, let's see what the numbers show, is that they need to do a lot more to shore up some of their core voting bases that they had in 2020.
Super Tuesday. 1 week away. Equity futures right now on the S&P 500, slightly positive, up by about 0.1% on the S&P 500. Coming up on this program, US regulators issue a scathing assessment of Boeing's safety culture following the nearly catastrophic incident earlier this year. That conversation up next from New York. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Snapped a three-day winning streak on the S&P in yesterday's session. Small day of losses. This morning, small day of gains. Up by 0.1% on the S&P, up by 0.15% on the Nasdaq. This hour, littered with earnings. We had Lowe's a little bit earlier. We'll have Macy's later this hour. We'll break those down for you in just a moment. In the bond market, 2-year, 10-year, 30-year. Ton of issuance yesterday. We'll get a 7-year issue a little bit later today. Yields were pushing higher through the curve, the 2-year. Just south of 470 at 469.12. We're down about 2 or 3 basis points there. On a 10-year yield, 427.37, basically unchanged. It's not just the Treasury supply we need to keep an eye on. Also need to talk about corporate credit supply. Bramo, what a month so far in February.
It's been record across the board. And it's not just investment grade. You're also looking at some of the lower rated companies as well that are issuing debt. And spreads are still at the tightest levels going back for basically a year. So what you can basically say here and infer is that all that cash on the sidelines that people keep talking about is going somewhere. And maybe, you know, this is the haven.
I think I saw the headline yesterday. It was the busiest month going back to April 2020. April 2020 was a different world. You're rushing to issue debt. Spreads have gapped wider off the back of the pandemic. We're issuing debt for survival, for the purposes of surviving through the shutdown. And here we are a few years later, and we're talking about spreads being incredibly tight. This debt is being gobbled up, even with rates at multi-decade highs, with no sign, at least in the next several months going through June, of this Fed itching to cut rates anytime soon.
So 2 things here. Number one, in April 2020, it was fueled by this feeling that the Fed had your back and that they were going to cut rates to zero. So even though spreads were wider, the all-in borrowing cost was rock bottom. Now we're talking about companies where the all-in borrowing costs, even with really tight spreads, are not that low relative to where they've been historically, and yet companies still can issue debt. And oh yeah, still some of the investors are coming out and saying, you look just as creditworthy, if not much more than you did before, and you can absolutely pay it back. This is the most bullish market, considering where we came and how much people were pessimistic that I can imagine.
This moment is very different to where we were 4 years ago. I'm going to do my best here to make foreign exchange interesting for you.
It is actually.
Good.
I have interest today.
Good. I've got stuff to say as well. So I'll say my stuff, and you can say your stuff.
That sounds great.
In just a moment, okay? Is everyone ready for this? The euro, unchanged, 108.55. But Kit Jukes of SocGen says it could get interesting. This is what Kit's got to say about it. Whether the Fed or the ECB cuts first or fastest will determine where euro dollar goes this year. But if they are both moving in the same direction, the pair won't go very far in either direction. However, here's the however, bear with me. If it were to become clear in the months ahead that the Fed's next move will be a